Our first speaker is Matt Yates from InterBay Commercial. He's their specialist finance account manager. I met Matt for the first time last week. He previously was working for a sister company of InterBay and has recently moved across over to InterBay and now covers quite a big chunk of the I think Matt's based up in Norwich. That's the sort of area he covers. We're in West Hertfordshire, so it's a bit of a trek for him. But so welcome back. Can you hear us first of all, and can we hear you?
Yes, absolutely. Can
Fantastic.
You hear me?
I love it when technology works. Right. Okay.
Oh, thank God for that.
You've all been today. You've all been sent for all the speakers. You've been sent the product guides for each of the lenders. Should you wish us to go through, so is there anything you've got regarding rates, what interest rates are being charged, just take a look at what we've sent you. I have condensed down InterBay's. It was about, I think, about 27 pages long. We've condensed it down to 7, just so you're not reading War and Peace. You actually, you can just get to the bits you want to get to. So that's their product guide. So just check your email. If you've not got it, then pop an email to me or check your spam, pop an email to me, and we can make sure it comes over to you. Okay, so a little bit about Matt. Matt has been working in the mortgage industry since 2005. Starting with one account, he helped start up RBS IP, which I believe is Royal Bank of Scotland, which later became NatWest Intermediary Solutions. Matt progressed to a field sales position with Platform and then moved to Precise Mortgages, sister company of InterBay. Matt took the opportunity to take a sidestep to InterBay in October last year and is currently working as specialist finance account manager whilst continuing to help brokers with precise bridging finance. Matt's interesting fact, Matt used to breakdance in the 1980s and danced at a London stage, BBC TV, as well as a number of seasons in Pontins. Now, we do try on the Specialist Mortgage Web Show, when someone comes up with something like that, to try and find images from the internet. Absolutely nothing. Unfortunately, Matt Yates is a common name. And I couldn't find anything, but I'm not going to give up searching. So the next time we might have a little video of him breakdancing in the mid-80s to something. And he promises not to breakdance whilst he's doing his presentation today. So
try not to.
He'll probably break something. Matt, next slide's yours. Over to you. I'll see you in 20 minutes.
Thank you very much, Tony. How can I follow that? How can I follow the FCA? Well, quite easily, actually. Yeah, you won't find anything back from the 80s. Thank God that social media wasn't about then. That's all I can say. So welcome for everyone, and thank you very much for having me, Tony. It's nice to participate, and it's nice to talk about the business that I've recently moved over into. As Tony said, I've been working within one savings bank for a good few years under the guise of Precise, and I took the chance to move over to InterBay last year. Which has been a great move, learning new things about commercial finance, helping different firms. And as Tony did say, yes, my patch is considerably bigger. But with the business that it is, there are fewer firms and fewer brokers that deal with commercial finance. So I'm finding different firms to work with, which has all been very exciting. Right, so just a bit of an overview of the bigger business. One savings bank, you may or may not know this, is Precise Mortgages, Kent Reliance and InterBay. Now, what the bigger business wants to do is really align those 3 brands. So it's a one-stop shop. So Precise Mortgages is your volume, buy-to-let and adverse residential lender, kind of off the shelf, if you like. And then you've got Kent Reliance, which will do the bigger buy-to-let stuff that Precise can't handle, and some of the other residential stuff that they don't do as well. And InterBay very firmly focuses on commercial, but also has like a complex buy-to-let arm, the big stuff that Kent and Precise can't really help with. But I'm not going to talk about that today. Today is purely about commercial. I've only got a few slides. I'm not slide heavy. Death by, I think for the first presentation, it's probably best not to ruin it all with plenty of slides. What I am going to do is just run through a few examples of what I've been talking about recently and where brokers have submitted cases, just to give you a flavour of some examples of what other landlords are doing at the moment and how our criteria kind of fits in with that. So there's 2 main areas. There's obviously InterBay Commercial and there's InterBay Semi-Commercial. And very recently, we've just changed a lot of the criteria. We really wanted to go back to 2019 lending levels. We're a very big lender then, and obviously when COVID hit, we had to scale back a lot of the options that we were offering brokers and firms. And so only very recently we've come back with increases in loan to value, more of an appetite in certain properties, and reduced some of the prices as well. And firms like Tony's as well have welcomed that. and I know a lot of my competitors are also looking to change. So it's going to become a very competitive area. And what I've found interesting for me is the path that I've taken. Your typical landlord seems to be now in a position, if they've got 3 or 4 properties to their name, let's say they've got some HMOs or some multi-units, they may be starting to look into the world of commercial. There's lots of opportunities for landlords in the commercial market. That is one thing that has been absolutely apparent that I've learned since I've been here. And the process for owning it is very simple. The yield is considerably better. So it's a really exciting time. I think this year, I think landlords are going to be starting to become a lot more adventurous with the kind of properties that they will go for. So a bit of an overview of commercial, semi-commercial and holiday let. The buy-to-let option is pretty good for portfolio loans, and I've got a good example of a commercial portfolio loan that I've done recently. We, on the buy-to-let side, as I mentioned, cater for the large HMOs and multi-units. Very good underwriting team, actually, that take a very bespoke view on a case, looking to lend, really looking for the positives on the case and going, yeah, we can do this. This is the kind of information I need. So, and that's where I help the likes of Specialist Hub in talking about your cases, talking about how we can get that case through. And I'll come on to that more a little bit later on. Why should you InterBay it? Indeed. There's just a couple of slides now. Semi-commercial. Not a massive fan of running through criteria. You can find all this yourself, but a bit of an overview before I give you some examples wouldn't harm. So 75% is the maximum run on semi-commercial. The minimum loan size is reduced to 50k. Now, a couple of weeks back, it was 150. Now, the 50k is going to help if someone has got a smaller or a low value property. Now, the minimum property value has gone to 150. So that's basically us just saying, all right, we'll look to lend on a lower loan amount, but the property still needs to be a considerable value. 150 is about right. Interest only is a big area. A lot of the high street commercial banks aren't keen on lending on an interest only basis on commercial mortgages. We're comfortable, and I've been getting quite a few deals off the back of high street saying no to an interest only, where it's very much an objective for the landlord that they want interest only for like 10 years. So that's another area for us. There's a lot of flexibility, particularly on semi-commercial. There's a lot of flexibility on the commercial element. The reason I'm saying that is with a semi-commercial, let's just picture it in your mind. Pick a typical high street where you've got a kebab house, for example, a kebab shop that's done very well in the last 2 years, and it's got a flat or a couple of flats above it. Now, if the rent from the flats covers the loan amount, there's a lot of flexibility on the commercial. We'd also lend on many different commercial properties if there are flats involved. Semi-commercial is commercial with residential properties attached to it, either on the side, behind, or above it. And it's generally like a shop with some flats above it. Now, I can do the big ticket stuff. Very proud of a very recent one I've done for £6.1 million. And when it comes to commercial, there are some big commercial properties out there. So the bigger the better. We'll take a view on it. And there's different areas that I go down in my business to check before Specialist Hub put pen to paper that we can do it. So the big deals are where we're favourable at the moment. Okay, I'm going to give you a couple of examples of some semi-commercial cases that I've recently done, just to give you an idea. Okay, so the first one, it was a property where there was 2 flats above a newsagent. Now, the landlord wanted to buy the building with the newsagent tenant continuing to trade. Now, there's a bit of a problem. The newsagent, the business owner, hadn't actually been in there very long. So there wasn't much of a track record of how well the newsagent was doing. And this is where the flexibility of semi-commercial came in. The 2 flats above the newsagent had such a good yield that we didn't need any rent from the commercial element to fit the loan amount. That meant we weren't too concerned about the trading history of the newsagent. And on that basis, we're more than happy to lend to it. That's a very common example of semi-commercial, okay? Another one, a small flat above a large restaurant. Now, the reason I mention large restaurant is quite a few lenders have certain percentages of residential and commercial that they will work with. We don't. You can have a big commercial with a small flat above it. That's still a semi-commercial mortgage. This scenario was actually a remortgage. The applicant owned the building and they were looking to raise money to buy other properties. And we weren't too bothered about what the properties were. In fact, we're not overly concerned as long as it's for any legal reason what people can borrow money for on their commercial. Now, the flat was not let out. The flat housed the staff of the restaurant. Okay, so it was all kind of tied up. There wasn't any real rent to see there. However, it was an established restaurant. It done well in COVID times because it did a good delivery and a takeaway service, and the net profit from the restaurant and the rent obtained was more than enough for the loan. And again, I think with this scenario, they wanted an interest only, and they approached the high street, and the high street weren't too keen to lend in this scenario for interest only. So we're more than happy to consider it on interest only for a 10-year term. So just to summarize on semi-commercial, we really like it if there's some good rental yielding flats involved. The pressure's off on the commercial. Okay, there's any percentage, and you could have trading business or owner occupier. Doesn't really matter to us. But this is our sweet spot for lending. Okay, semi-commercial. Right, I'm just going to finish off with commercial lending. As I say, this is a real light overview of my proposition, just to give you an idea of what landlords are doing at the moment. So, similar loan to value, and that's good because it's now 75%. A couple of weeks back, it was 65. So our appetite for commercial has increased. Just to give you a flavour of rates, commercial are between 5 and 6%, starts at 5.39, semi-commercial between 4 and 5%. That's just to give you an idea of where the rates are. And as I mentioned, interest only is a big, big thing at the moment for a lot of landlords, and that's something we're more than comfortable to do. One thing I did mention on the other slide was there's a 0.25 reduction in fees for existing borrowers. Now we're still just starting, should I say, to see repeat customers come back. Now we want the repeat customers to come back, and the arrangement fee is lower for landlords that have done business with us before. And like the semi-commercial proposition, if you've got a big, big property, big loan amount requirement, that's something we're more than comfortable to work with. And I have worked with specialist hub before on, so we can package it up for you and make sure it's a deal that we can do. Proc fees, obviously, with commercial lenders are a bit of an appetite as well, so they're generally higher than high street lenders. Let's finish off with a couple of scenarios of commercial, just to give you an idea of how it varies slightly. Now, commercial is obviously just commercial. There's no residential properties involved in it. We've got to be very aware of certain areas in our towns and cities that aren't doing very well. I think all of us can think of walking through a large town or a city and seeing some very large retail units that are empty. Now, as Tony said, I live in Norwich, and there's a very large Debenhams and there's a very large Topshop, two big buildings that are empty. No doubt they'll be turned into flats at some point, but we are very cautious about lending on resale. We are also very cautious about lending on offices. They're the two biggest areas still that there's a bit of uncertainty there because people work from home. There's a lot of empty offices now. Nearly every other example of a standard kind of commercial proposition is going to be up for grabs. Let's just talk through a couple of examples to give you an idea. So, a case I did a couple of weeks back. This particular landlord had 3 commercial units he'd like to remortgage. Now, these were all separate, so own titles, own leases, but he wanted one mortgage. It was a portfolio loan over 3 commercial units, a storage unit, a parcel delivery firm, could have been PDP or something like that, and the last one was a garage. Now, these were all good commercial, solid industrial units on the outside of the town, and we were happy individually with them, but we were also happy for one application to come in and all 3 of these to be rolled up onto one mortgage payment on one deal. Now, we went to 75% loan to value on this because the rental yield was strong, And again, in this scenario, they wanted to capital raise to invest in the applicant's main business. So it wasn't to buy other properties, it was to invest money into their main business. Another great option of the flexibility of what you can borrow money for. Now, last scenario, and this is very recent because we've only just come back into this, is a hotel purchase. We can now consider landlords to buy hotels, B&Bs and guest houses. Now, this particular landlord was an experienced commercial landlord, and that's very important to say at this point. When you're doing commercial finance, we really like the applicants to have experience of running, letting and owning commercial properties. With semi-commercial, there might be some flexibility if they've just got a few buy-to-lets. But because the risk increases with commercial, because you haven't got that flat aspect there, we do like the landlords to have experience. Anyway, this was an experienced commercial landlord looking to take advantage of the current UK's staycation appetite. Well, let's see how much that changes. I know everyone, man and his dog, are going abroad this year. Anyway, wants to buy a hotel. The short-term outlook is to continue with the business owners still running it, but the long term is for him to run it himself. Now, that was a good choice because he didn't actually have any experience of running a hotel, but with that business objective, we were more than happy to consider 75%. He had some other commercial properties running in the background. This was a different venture, but something we're more than happy to work with if the business objective is the right objective there. So I've just given you 4 examples, 2 of semi and 2 of commercial. No 2 scenarios are the same. Every single day something crops up which is a bit quirky and different. I hope that gives you a bit of an idea of areas that InterBay can help and how I can work with Specialist Hub to get them through. I would welcome any questions.
Matt, thank you. Absolutely brilliant. 30 seconds ahead of schedule, so fabulous.
Well, there we go.
Like it. Nice one.
Time
okay, we have got some questions. I forgot to mention, actually, delegates, that we do ask, just in case there are no questions, we do ask the speakers to set their own questions. So I do have 2 that Matt's actually set himself, but we do have some questions from you as well. So I'll just read these out to you, Matt. So please. Janak has asked, please can Matt clarify the semi-commercial mortgage and what is the ratio of the property for commercial and residential area?
There isn't a ratio for commercial and residential. Now, good question, because most other lenders do have a percentage ratio. We do not. It could be 90-10, 50-50. It doesn't matter.
Excellent.
Hope that answers the question.
Yeah, it does. Barty has asked the question, Matt, for semi-commercial property, what is the maximum age to apply?
We can do a 75-year-old. There's a little bit of element of flexibility on it, but at the moment it's we can accept up to the age of 75. Okay, and it's usually shorter terms that we do, so most of them in sort of 60s or 50s up to the age of 75.
If you had a situation where you had a father and son, the son was 70, son was 30, would you look at the lower end of the scale?
This is a good example, I think, of where an underwriter can look at the benefits of the case and think, yeah, I think there's a good chance that the son will probably be leading the business in the near future. So I would say that is something I'd take to an underwriter, and we'd look favourably at an example like that.
And there will probably be another 10 examples I could probably give where there's flexibility. So the best thing to do is always to make the phone call, and we'll find out. It might be a situation we don't even need to find out because it's something we've done recently. So. Okay, Julian has asked, what are the max bedrooms in an HMO?
Pick your number, many as you want.
There's not, basically.
I've done a 31 bedroom HMO in Nottingham, and it was a whopper, and did it on commercial terms, and did a commercial valuation, and it worked out quite nicely. I think the valuation is due to come back anytime soon, so I'll be looking to see how that worked out. Bigger the better. Bigger the better.
I think we placed one with you that it is actually an example, a case study that I'm giving later on today. That I think we put this to you, which is a 21 bed HMO. So again, there isn't a limit with InterBay because they're a sister company of Precise and Kent Reliance. You'll find that Kent Reliance and Precise have got restrictions in place, but InterBay, being the specialist lender out of the 3. Don't have those sort of restrictions. They'll do the stuff that the other 2 can't. So, okay, let's just see. There has been some more questions. So, Rory has asked, will you fund children's nurseries purchase of the building to an experienced operator?
Yes.
In a nutshell, yes.
Subject to the finer details, yes.
Yes.
I have to remember this because we do have an unacceptable list of commercial, and there's some very interesting things on there, like gentlemen's clubs. I don't know why gentlemen's club sticks in my mind. Do apologise. There's other things on there that we're not going to be comfortable with. Car washes. There we go. I turned on a car wash the other day. I think that came from your office, actually. Sorry. There's a nursery on there. Children's nurseries are fine, but garden centres, I don't think we are. And I always get mixed up with the nurseries. So I will say provisionally yes, but if you want to send over more details, I'll be more than happy to look into it.
We normally find children's nurseries don't have a problem with cash flow or profitability. Again, I've got another example later on that is a children's nursery.
I think we're fine with it, yeah. I just get confused with the nursery side. I think it's garden nurseries for some reason we're not seem to be comfortable on, but there we go.
I'm just glad I haven't got young children now, because the prices that some of my staff having to pay to put their children into nurseries so they can go to work is just astronomical. It is ridiculous. Okay, that's the end. There's no more questions from.
Well, thank you for the question.
So I'm going to ask the two that you set yourself. So this is your big test.
Okay.
I'll read you the right lender as well, otherwise you might get stuck. Where do you stand out against other lenders in the marketplace? And I suppose this is probably the lenders that are your immediate competition.
Immediate competitors,
the likes of Shawbrook, Alica, etc.
And it's a good question, because I think since I've sort of moved over, you instantly look at who are the other lenders in the marketplace, and it's not as busy as, say, bridging, where there's hundreds of bridging lenders. There's very few that in the marketplace, and the same ones do crop up. And I've asked the question to the brokers and firms that have done business with me before, how do we stand out? So I've asked brokers this question. The kind of things that have come back is consistency of underwriting. So if you send a case in, it's an AIP, and an AIP is pretty much a full underwrite. So from that point, the terms and the decision-making shouldn't really change unless the valuation report comes back otherwise, and then the loan amount might change. But the overriding feedback I've had is consistency. Now, the key thing here is, and I might come onto this in a minute actually, is to talk about it pre-submission and to make sure that we get the right case in, and so making the job easy for an underwriter. So the decision-making will very rarely change once that initial agreement from the AIP has been given. Little things like interest only, 75% commercial, and the underwriting process is geared up to, as soon as we first touch the case, let's give you the right answer, and so we can proceed with the application without any sort of challenges going forward. So consistency is the answer there, really, Tony.
Okay. Next question, final question you set yourself was, how do you help us at Specialist Hub in getting the right outcome for a client if an application is submitted?
Okay, so I nearly kind of alluded to it in my last answer, but everything is about pre-submission. It's about understanding the client, the property, the background, any challenges, doing as much work before an AIP is submitted, to ensure it's the right deal and you're not wasting anyone's time and it can come in. But I work very closely with my brokers, and I do have at my disposal some very senior and knowledgeable people at head office that I can refer stuff to. In fact, I probably do it 2 or 3 times a day with some deals just to get some clarity it's the right thing. And that breeds a bit of trust, and it breeds a bit of respect, I think, that we're doing as much as we can before you put pen to paper and do an AIP. Ultimately, it helps the underwriters and it saves time when the case in as well. And that's the kind of thing that I like to do with your firm, Tony, and other firms, is really get to the heart of the client's requirements before you kind of as you start doing the AIP. And that, in the last few months, has worked absolutely brilliantly with some very good results and ultimately a lot of time saving as well.
Submission how cases submitted in the commercial arena is absolutely key. That's the part where you're trying to sell the deal to the lender. So we tend to, there's a couple of things that we do which are, we're told, fairly unique in the market. The first thing we do is we have the ability to credit search in-house. I'm going to cover again this later, but we will search in-house. That way we're not submitting the case, the lender's then going to search. It comes up with something and immediately they go, don't like that, wasn't aware of that, that wasn't declared. The second thing we've got is we've got our own sourcing system for commercial. So this will check basically search the lenders that we have on panel, which is a substantial number now. I lose count. There's so many come back to market. and it will work out whether it fits on the affordability, look at the rental income, and use the lender's rental calculations. There is some tolerances involved, so if there's a deal that's borderline, we can then refer it, but we've got the information to hand. So I'll be going to Matt saying, we've got this case completely clean, never any problems, or Matt, we've got this case, had a CCJ 5 years ago, so there's no nasty surprises. And then he's going to either come back and say, yeah, that's one that we feel we can support, or no, it's one we feel it's a little bit too much for us. But the majority of cases, and this is why we've written so much business with InterBay over the years, and for quite some time we was their largest broker, until some of the really big guys sort of took over. We've done a lot of business, and in excess of 100 million quid according to our records. So over the past, what is that? And that's excluding pretty much 2020 and 2021, which were write-off years as far as I was concerned. It is about the submission, and that's absolutely key. If commercial is not something you're experienced in, that's where we can help.
Absolutely.
Okay, Matt, we are 2 minutes ahead of time, so absolutely brilliant. Thank you for your first presentation with us.
You're more than welcome.
No hiccups, which I always like to see. My IT department will remove you from the room. We do this now because a delegate last year did almost manage to close down the entire show by kicking on something. In a minute, Matt will disappear. Matt, I'll speak to you soon.
Thank you very much,
and our next speaker will appear. So our next speaker is Steve Smith from Roma Finance, who we find to be an absolutely superb lender. My bridging team absolutely love them. Very proactive, they want to write business basically, but they want to write business in the right way, which is absolutely key in the bridging market. So once again, what we're going to do is we've sent you this today. Now this is hot off the press. Steve, I don't know if you've actually issued this as yet to your...
Literally this morning.
Fine. Okay. So we was waiting on this yesterday. It came over late yesterday afternoon. This is their new product range. Came out quite literally late yesterday afternoon. So you've all got this morning. Again, if you haven't got it, no one has actually registered since I've started talking. So if you haven't got an email from us with the terms, just pop an email to us or contact the team, and they'll get something over to you. A little bit on Steve, first of all. Steve is Sales Director for Roma Finance, executing the commercial strategy and managing the sales team to enhance the broker experience and business growth. He has an impressive background, is dedicated to supporting the intermediary market. It's a spelling mistake there. That's us, I believe. His career began with Bank of Scotland, progressing through to the commercial into regional manager. Moving to a financial brokerage, he became the commercial manager running the sales team and underwriting asset finance, property finance, and business loans. Steve joined Roma as a BDM back in 2016, looking after the Southwest and South Wales before working for Shawbrook and then Glenhawk. He returned to Roma in 2019 as senior BDM, promoted in 2021 to national sales manager, and congratulations, now sales director in 2022. So onwards and upwards, eh? Nice one.
Yes.
Okay, Steve's interesting fact, he's a published author. He wrote a book called The Path to Redemption, which is very highly rated. And if you're very quick, take a photograph of that if you want to read Steve's book. I'm only going to cut a 10% of the profits, by the way. So that's all he's prepared to give me. So, but if you do want to actually take a look at Steve's book, I'm not sure what it's about because I haven't read it.
Shocking.
I'm sure it's very, very good. I haven't had my free copy. That's the reason why. I'd have to declare that in the FCA interest book, wouldn't I, if I do get free copy? Right. So, Steve, over to you. I will see you in about 20 minutes. We are bang on time still. So it's with you.
Thank you kindly. Thanks for having me. Good morning, all. I'll keep it fairly brief. I'm fairly light on the actual slides as well, which is probably to your excitement. I'll talk a little bit about what we do. We're a bridging company, as no doubt you're aware, or hopefully you're aware. We do sort of everything from the borrower. So basically, we look at the borrower first. So as a broker, we want you to understand what your borrower's motivation is, why they want a bridge or a development loan, what's their background experience, what's their exit, which is hugely important in bridging, and sort of we underwrite that person, not the property. Now, a lot of our competitors don't. They basically, and there's nothing wrong with it. There's different ways of doing bridging. Some people just write, and you need to know that really as a broker to see who's best fit for you. Because if you've got a really, really good borrower, but an awful property, you probably want to come to us. If you've got an awful borrower but a very good property, that's not our bag. So it's finding you as a broker, really talk to specialists to see who the best funders are for your type of borrowers. But for us, it's all about borrower first. and that's really important for us as we move forward. So what do we do at Roma? Residential and bridging finance, which also includes semi-commercial and commercial. We do auction finance through our Roma flow, so it's very quick, which I'll talk about later on. We do a lot of refurbishment. That's probably our biggest, and we split our refurbishments by light, medium and heavy. But our standard bridge also covers off 20% of a refurbishment. So the cost of the property, 20% of that or less. If it's just like they're just going to do a little paint job or sort of put in a bathroom, it's quite low value. We can do that on a standard bridge. We also do ground up developments, a huge amount of that as well. That includes commercial ground up developments, which is a new thing that's come out this morning. As you say, the new product guide's just come out literally about 40 minutes ago. We also have a term loan, which we look at for buy-to-let, holiday-let, serviced accommodation. So we do the whole gamut really with short-term finance. If you look at sort of exit strategies, it's one of the big things that everybody should really talk about when taking a bridge, because a bridge can be as cheap or as expensive as you need it to be, really. It's about the costs involved. Everybody used to years ago go, oh, bridging's so expensive. Well, at the moment, you can get a bridge even through us at 0.59%. For you know, if you're doing that for 3 months, it's hardly expensive. If you're just going to do that and then split it onto a term loan, go to get a mortgage, move on to your development, whatever you're going to do with that, if your exit strategy is clear and realistic and agreed by everybody, and I mean everybody, so that is your broker, your solicitor, your valuer, your builder, whoever it is, as well as the funder, it is a really good way of getting money out and not spending extra money on interest. It really is important. Always ask your customer, your borrower, about an exit strategy, because it's probably the most important thing. It's probably one of the first things I'll ever talk about. Someone said they want a bridge. It'll be, okay, tell me about the borrower. What are they going to do it for and what their exit? And they're the sort of straight away I can give you a yes or no really within a couple of seconds. This horrible slide, quite frankly, is customer for life. It's something we've brought on, and what it does, and I'll try and explain it with the various arrows. So with us, you can go to an auction, buy a property, do it up. We'll give you the money for the purchase, and we'll give you money for the refurb. You'll do it up, then we'll flip you onto a term loan. Great, you stay with us. Once that term loan, the beauty of that is you pay obviously a lower amount and put some money in to do the refurb and make the extra amount. So say you get, let's give an example of a residential property bought at auction. You're going to do a little bit of work, sort of 20 grand's worth of work, and it's worth 150. So class is a standard bridge. You'll go with us. So you'll do it for 3 to 6 months, 0.59%, then flip it onto a term loan. You can then get 75% of the uplifted value to go onto that term loan. So say you do that, you can maybe get the deposit, take that money out, put a deposit on your next auction purchase, and then go to a term, which is what they're looking at. And we can also do something different where there's a development loan. So you do a ground up development. So we got land, we're going to give you the money for that development. Once that's wind and watertight, we'll put you onto a cheaper set of bridging finance rather than development finance. And then once that's complete, we'll go to a term, and so forth and so forth. So again, it's probably really important for your borrowers to talk to you about it so that you understand, but also for you to understand how Roma work and what we can actually do, because we can change things within a deal, as I'll explain later on, and show you some examples of what we've done with really complicated deals, but simplified them, which makes it much, much cheaper. So it's not just about rate and a headline rate, it's about understanding your borrower, which is a big part of what Roma Finance is. And so for any of you out there that don't know us, go through specialists to our BDMs. They're all readily available. I've got 10 of them in my team all over the country, so they'll speak to you about any deal. And it is very important. So some case studies. Now, this sort of highlights probably where Roma is in the market. Our rates have just gone down this morning. As you said, the rates have come out, so we're pretty much there on rate. We're not the very cheapest. We're certainly nowhere near the most expensive. But what we are is a bunch of people that want to lend to people who want to do property finance. So we're an unregulated lender. We do lending in a regulated way. So we don't want to pay off people's debts. We don't want to pay off people's divorces. We want to give money to people who are investing in property, whether that's a development loan, whether that's a refurb, whether that's just a purchase and then a flip, whatever it is, but it's property based. So this one, for example, the first one I'm looking at, it was a light refurb on a renovation to let. They purchased 2 properties next to each other and renovated and rented them out. It was a fast track case with Roma Flow, so it was done, I think this one was in 11 days from start to finish. That included a valuation. And they had issues with the EPC because it had a rating of F, and that's going to become more and more popular as you talk about all of these things. Every funder is now looking at sort of green mortgages, green loans, green bridging, because of the EPC rating and the issues that brings. So they did some refurb on it and basically made it up to a C rating, which is important. And then once completed, the GDV of the property was 290. So they made a really good amount of money. And then we just exited the bridge via a buy-to-let mortgage as they originally planned. It was a really clean case where it was, they're actually first-time purchasers, but it was a very clean case. They had very little work to do. They renovated in a quick time. They got the money in a quick time, and they exited in a quick time. So all in all, very happy customers, and we're very happy because we're doing a second one with them as we speak. And that's what it's all about. At Rome, we probably do at the moment 30-35% repeat business. That works for the broker because obviously every time they come back, we give you commission again, so nobody loses out. And it's a good way of getting that repeat business, understanding your borrower again. It all goes back to that understanding of a borrower's needs, having the adult conversations. We all love technology, and so do I. It's great to do this to you, all you guys, but nothing beats having a coffee with somebody or a beer, depending on what time of day, and talking about what they want to do and understanding your borrower. That's a BDM, an underwriter, a valuer, or a solicitor. Just have that conversation, and I think that's really important. On this one, shows you a bit of our flexibility. Obviously, there was the pandemic, as we know, had major effects. We had a customer who was actually introduced by Cambridge Building Society, who are one of our backers. We have 9 backers, all established British banks and finance houses. So we're very well funded, hence we're very much out there to help the marketplace and help people develop. In the last 8 months, our business has doubled in size. It's that simple, and that is, through difficult conditions with COVID. So on this one, we created a Roma development facility, 100% of the build costs. Once we got it to wind and watertight, we flipped it onto a cheaper bridge. So they kind of halved their costs on the bridging interest. And then the project began on time. It was massively delayed by the pandemic. And the original loan term had to be doubled. But in line with what we actually put in place with the COVID policy, no additional fees were charged for that extension. That extension was done at the very same rate with no additional fees on top as the original COVID was. And we worked throughout COVID, I can honestly say, because although some of our staff are furloughed, unfortunately or fortunately, I'm not quite sure which, I was not. So I worked throughout the pandemic, and we worked throughout the pandemic because property was one of the few things, fortunately, that did well in that pandemic situation in the main. So this was a really good guy. He's very thrilled with us again. He's now on his 3rd one with us. And as you look at you can probably see slightly the case. He's done a fantastic job on that. He really has. He's done an absolutely fantastic job on that. The next one is quite complicated and quite convoluted, so I'll try and keep it simple. There was a whole site here which a guy bought for an absolute steal, 455 grand. It might not sound a steal, but there were literally, it's a huge area. You can't really see on the map, but it's a commercial building with various shops, closed down shops, offices above, and then some sort of derelict buildings at the back. And what he's basically doing is we gave him 280 grand, I think it was 260 maybe, on a first charge straight away. He had no planning at that time. He just wanted to help the funding to get it. So we helped him buy it, and then we sat down with him, and I was actually involved in this deal. Went out to see him, and basically he just basically sat there with his architects and decided what he wanted to do. And he's transforming this. It's going through the process at the moment, but he's building townhouses at the back. He's got planning now, development. We're obviously helping him with that development funding as it's going on. He's building 5 townhouses in the courtyard. He's basically changed the whole facade of the front. It will look amazing. And hopefully, we'll put it on the website, this one, because it's a really good one to do, because we were one of the few funds who would look at it because it was a fully commercial, half derelict property. And again, the borrower was fantastic. We really believed in him. He knew what he was doing. So the property doesn't matter so much. As long as he could tell us what his exit strategy was. We had massive comfort with him as a person, as well as seeing his architect and his team. His builders were the same builders that he used all the time. So really comfortable with what he was doing. So we sort of stretched ourselves on this one. And everything that he's got in this will be sort of a Roma customer for life, if you like. We are doing with this. We did a bridge to buy it. We then did to get him to get planning. We then did the development loan to build the house at the back. We gave him a bridging loan to develop the front and to make it all more modern. And then we'll flip it all out onto a term loan as well at the back end. So he's got some funding for 5 years. So it was a really interesting one to do. It was quite an interesting one to look at, and it's a case that's ongoing, so I can't show you how nice it's going to be. But if it's anything like the plans, trust me, it will be another beautiful transaction, and again, a repeat customer of ours. So everybody wins all over the place, and that's what's important, I think. The final case study is an interesting one because, again, going back to the green world of ours, and green mortgages and green bridging, green developments are a big, big feature and will become even more so as we go into the next couple of years. This one, we funded the very first development of what's called a passive house. It's in Scotland, and basically it means it's an EPC rating of A. It is absolutely self-sufficient. It needs no electricity and gas because it provides everything itself. Very, very green. As you can see from the design features on it, it's beautiful inside. I haven't been there myself, but I had a video call with a chap once he'd finished it, and he was very proud of himself, and justly so. Obviously, we had issues on this one because it was quite a big deal. It was quite a big ground-up development deal in Scotland, and with the Scottish law, it makes it more difficult, but we fund completely in Scotland. We've got no issues with Scotland. We do England, Scotland, and Wales. We helped buy the property for him, and then we helped develop it. The main problem we had was that the valuer had nothing to go on whatsoever because there was not another passive house built in Scotland. So he had absolutely nothing he could say what the valuation was. He had nothing to go on. There were no direct comparisons. So we used, in the end, sort of common sense. We made the decision for the customer. We took a view. We looked at what the costings of the same passive houses were in Denmark and Sweden, believe it or not. We looked at that and thought, okay, let's have a look at that and see where we are. And actually, it's been a massive success. He's already gone on to his next project, and that was sold above his GDV figure. He sold it because there is a massive premium on these kind of houses. It's now this guy's passion. He's absolutely into building passive houses, full stop. And I don't blame him. His profit margin was almost doubled from what he imagined at the start of that conversation. Finally, really, Roma Flow. What we've tried to do, and we've listened to really you guys, the brokers out there, specialists, and everybody else who we work with across the country. We found that bridging, which should have been quick. That's how we started sort of years ago. We started in the auction world doing very quick deals. Became slower and slower due to COVID. There were valuations not going out. There were solicitors working from home. It all became a little bit sort of bogged down. And we were doing massive amounts of business, and it was all stuck in the whip. It was all stuck there. It's at legals, but it's been there a month. It shouldn't be there a month. And all of this. So we had to do something about it ourselves in-house. So we've created a new channel. It's been around now probably 3 or 4 months. And it's basically one of those where you have to put in far less information. We do a lot of stuff online for it. So you basically sign an agreement in principle, sign an application form, and get a valuation or an AVM sorted. That's it. Everything else is done online. Everything else is checked with things like open banking, with things like a CREDAS search, which is a sort of online search of your sort of passport and ID. And that works really well. So that's something to consider going forward as well. So that's me. That's about, I think time was about right, Tony. I'm not sure.
Perfect. Ahead of time, actually, Steve. Wonderful.
Even better.
Means I can eat earlier. So
and questions certainly.
My belly thanks you. So
no problem.
Okay, we've got a couple of questions. Farhad has said, "Morning, Steve. Can you do a bridge on land that already has planning consent? My client already owns it, unencumbered." Thanks.
Yes, we can. Absolutely. Yeah. So it's unencumbered and owned. It's got planning. Absolutely fine. We can do that. We'd probably do it combined with, if the customer wants some funds land, because presumably he wants to sort of then develop it. So we'd have a conversation about that. But yes, the answer is absolutely yes. And we could also most probably do 100% of the building costs as well.
Only, I'd say, obviously, depending where it is. If it's in the Outer Hebrides or the Shetlands or somewhere like that, then
yeah, I suppose that is true. We have done one out on the Orkneys, to be fair, but it was sort of in a town or / village, but it was in civilization of sorts. So,
okay. So I mean, that's the one. Obviously, one thing we have to look at. That sort of deal can be done all day long. But
absolutely.
Okay. Oh, he just replied. So it's been pumped all the questions up a bit. So Janek has said, "Hi Steve, can we?" I'm not quite sure how the wording. I'm not quite. I can't quite understand the wording. Can we lend bridging on a need fully refurbished before it could be let on itself? And what will be the LTV on that property?
Okay, so we can lend, we can bridge on a fully refurbished property. So if it needs to be refurbished, perhaps. So again, what I said, we can bridge it, we can pay for the refurb, and then once that's done, we can then flip it onto a term loan. You know, that if that's the answer, there's absolutely no problem with that. The LTV would depend on how much refurb it's done, but 75% if it's less than 20%, 70% if it's sort of up to 100%. So depending on where we are, but probably one for me to take on after it. Just give me a quick email on that, and I can sort you out exactly what you mean. But yes, we can sort of help to refurb, we can bridge for that, and then we can flip it onto a term loan afterwards.
Okay, Steve, these are your questions. So are there any types of exits you are finding more difficult?
Not probably anymore. The exits that we had problems with during COVID were the commercial exits, I'll be honest. We had a few term loan issues, which is where our own term loan came from, so we can exit some of our own bridges. But at the moment, the exits are looking all right. We're sort of, it's developed a lot better. There's a lot more commercial exits out there, and there's a lot of term loans in the market now, as well as mortgages. So exits themselves are fine. I think sales is, if the exit is sale, which we get a lot of, if it's residential, not a problem. Again, if it's commercial, you have to be a little bit careful. If it's retail or if it's office, it can take a little bit longer, because obviously a lot of people have changed their style of working now.
We always encourage clients to actually look at both options. So if they've got it up for sale, then obviously that's very market dependent. So also maybe just concurrently having something on a refinance, just so they don't get to the end of the term and go, oh, what we're going to do, and start panicking. Absolutely. So they've actually got something in place. And if they do sell it, then fine, no harm done. Yeah, so if they don't, then if we've already got a lender's already okayed it, subject to maybe, let's say, valuation, a new valuation, and obviously legals. Of course, Roma can still do the term stuff themselves. So it doesn't tend to be that much of an issue.
No, it's really, I suppose, the speed. If it's a sale exit on a commercial property and they think they'll get out in 6 months after they've done some work on it, sometimes you have to go, 3 months in. Are you sure? If it's sort of, a retail unit, for example, are you sure about your sale? Do you want to have that term loan, which we can put in place within a month, because we bridge the term ourselves, so we can put an exit stopgap in there if they need to.
Okay, your final question was, what does Roma do to help customers in challenging circumstances?
I suppose that was probably back to the COVID, where we worked all the way through, but we also extended all of the loans that needed to be extended. Sort of, I wouldn't say free of charge, but there are no additional fees at all. It was on the same rates with no additional fees put in place. So there was no problem. We've got absolutely, touch wood, no debt coming from COVID whatsoever. So all the clients actually that went through that, and there was some horrible processes, as you can imagine, we all know what happened during that time, but nobody actually suffered as a Roma customer during that time at all, to any detriment. So we're really proud of that. And I would say that, again, probably key from my message, it's all about the borrower. So if we understand the borrower and what the borrower is trying to do, there shouldn't be any problems with him moving forward, because we know his exit or his plans or what he wants to do with that money that we're providing for him, and we follow him through that. So as long as we understand where everybody is, and it's all about those conversations early doors, all fine, really, Tony.
It's one thing that's very important. The bridging market is awash with lenders out there. Absolutely. I mean, they're offering all sorts of stuff. We do some fairly heavy due diligence on our lenders. I'll give you an example. We came across two clients. One towards the end of 2020, and one in 2021. Both had bridging with I won't name the lender, but a particular lender who is raises their funding within the peer-to-peer market, basically. Both, because of COVID, both have eventually went over term. They absolutely slaughtered both clients to the tune of over £100,000 each. They said to both clients, so we knew it wasn't just a one-off. Both clients were actually got a phone call. If you sign a non-disclosure agreement, we'll knock 10 grand off. Now that lender should not be in the marketplace. But of course, that lender will be in the marketplace. What will happen? It will all go pear-shaped, and the FCA will go, we have to regulate this market. So, but that's the problem. There are bridging lenders out there that shouldn't be allowed to trade. Go to any trade show, you'll find probably 2/3 of the exhibitors are bridging lenders quite often. But there are a lot of good lenders out there. It's knowing who they are and avoiding the ones who are basically going to do something to your client that he will never be a client of yours again, and will never refer any business to you, because he will quite literally be trying to get out of a situation that he was never expecting in the first place. So dealing with the right lenders and knowing what their situation, what they will do if we had another wave of COVID, good God, no. If we had another wave of COVID, what would they do to their existing borrowers? Roma are one of the companies that we love to deal with because, quite simply, we know that client is not going to be taken. But yeah, Roma are here to make a profit, but they're not here to bankrupt the client. That's not what they're in business for. But there are some out there that are. So just be careful who you deal with. I mentioned this with the last speaker. We also we took the choice a good few years ago, and this is mainly when because of the regulated bridging side, we do have our own sourcing system for bridging as well. So quite simply, we will put the client's details into it. It will then pick out the lenders that are able to assist. What we'll then tend to do because there's a lot of lenders out there that are offering the 0.3 rates that they offer to certain clients that never really materialise, but they say they offer these rates. And Roma have got now at 0.59, so they're not the cheapest in the market by any sense. But in some of the deals, I mean, a couple of deals we've done recently, they've been slightly more expensive. We've had a phone call with them. Yeah, we want to do that deal. And because they've just dropped things just slightly, just to make themselves more competitive. So there's a level of flexibility as well. That's not to say that we'll go to Roma every single case saying we want to drop your rate, because we won't, because they're there to make a profit. And one of the most important things, having been through a fairly ghastly recession back in 2008, was I didn't have any lenders, because it got to the stage in 2007 that lenders' margins were so tight that when things dipped, all of a sudden they didn't have a business. So profitability for lenders is absolutely key. But they really are one of those lenders that now that we use them on a regular basis, and we've got packager status as well, by the way. And one of the case examples I'll give in my presentation later, he was an IFA that actually submitted a deal to us, and he's not really that experienced in bridging, but if he'd gone to Roma direct, he would have earned the same as we paid him. As simple as that. So again, absolutely key. So they are a lender. I mean, they are a lender that we value massively on our panel, because they're able to do business in such a way. There's not layers and layers and layers of like red tape you have to wade through, because they're a massive, massive lender. Like some, I won't name who the lenders are that I'm thinking of, but quite literally, we can speak with Steve, we can speak with Scott, the MD, we can speak with people high up the food chain if we need to, just to try and get that deal through or get that deal approved in the first place. So we have no more questions, Steve. So you've answered everybody's.
Lovely.
So thank you very much.
Wonderful,
wonderful as always. So everyone start getting the bridging cases together. Give us a call later. Steve, my IT team will take you out of the thing, so don't click anything. So they'll take you out. So our next speaker, John Thompson from Step One Finance. For those of you not heard of Step One, they are we used to call them a specialist second charge lender, but not so much specialist anymore, because they really have now moved more mainstream. So you should have received from me earlier on this, which is their Hello 2022. Some massive changes at Step One. They've been a lender of ours for many years, and they were sort of like always in sort of like the mid-market for products. They really have now gone for it. So there is now rates from less than 4% in the second charge market. There's not many offering that at the moment, probably only 3 or 4. So you should have that. Again, if you haven't got it, I don't think anyone else has registered with us since no one else. Sometimes we have people registering these at 12 o'clock and then asking us for the CPD for the full 3 hours, by the way. But there's no one since. So you should all have this. If you haven't, just ring the team. Okay, a little bit on John first of all. John is fully CMAP qualified and has over 20 years of experience in the second charge residential and second charge buy-to-let industry. Away from work, he's a keen sportsman who likes to play football, tennis, and he regularly visits the gym. He also enjoys countryside walks with his wife and children. John looks to me because John did our show back in November, and he looks to me like he's lost a little bit of weight since. Absolutely. Blimey, what's your secret? Please let me know.
It's to shave the beard off.
Oh, right. Okay. Well, okay. That's a way to start. But no, you really look like you lost a lot of weight. So John's interesting fact, I did this myself once. He's the team manager of his son's under-15s football team. Whether he'll reach under-18s I didn't. I gave up at under-17s because they.
No, it's getting very tough.
Horrible little gits. They really did. Anyway, so John, over to you. I'll see you in about 20 minutes.
Yeah, fantastic. Thanks, Tony. Okay, so I'm John Thompson. I'm the BDM for Step One Finance. So make sure my slides work. Could everybody see that? Okay, so today I'm going to give you an introduction all about Step One Finance. I'm going to go through some criteria highlights, some USPs where we stand out in the market, talk you through our income and affordability assessment, how we assess adverse credit, and just some technology upgrades that we've recently made, and then there'll be some that will be coming in the future as well for our launch of our phase 2 of products. Okay, so Step 1 Finance, we're based down in Woking, established in 2010. Mission to operate an industry-leading consumer finance platform, and we are built on traditional lending values. So a lot of our staff have worked in the secured loan market for a number of years, including myself, my boss, his boss, and a lot of our underwriters as well. Okay, we look to find products which are understandable and provide real solution for our customers, and we want to provide creative and effective lending solutions ultimately, for those customers. And we focus on offering customers a personal service. Okay, lend transparently and responsibly as well. As I've mentioned, we've got a management team with loads of experience. My boss Hayden's been in the industry for over 20 years. And Martin, who's our head of lending, he's been in the industry for around about 30 years plus. Okay, so what we do, we offer second charge residential and second charge buy-to-let products, and we've got some fantastic new rates that we've launched in mid-November. So I'll cover all that with you today. Ultimately, you're going to have access to experienced team of underwriters as well. So if you're placing business through Specialist Hub, obviously, and it comes to us, your customers will be well looked after. Okay, so just some criteria highlights. We'll lend your customers between 5,000 and up to $500,000. Anything over 200,000, you need to refer via Tony's team. They get in touch with me and my boss. We'd obviously look to do the loan over 200,000 on referral if it's the right thing for the customers and obviously ourselves as well. For second charge buy-to-lets, we do up to 150k without referral, but you can refer if you need to above that. Okay, loan terms, we offer loan terms between 6 and up to 30 years, and there's no maximum age. So this is a real good selling point for Step 1 Finance. We do customers who will lend, into retirement. We'll do loans for elderly customers if it's the right thing for the customer. So if it's going to be sustainable for the customer, into retirement, then we will lend to that customer. Okay, so no maximum age as long as it's plausible and sustainable, the customer will be able to afford it going forward. Okay, so we're now offering some fantastic rates. So rates starting at 3.85% on the residential cases. There's no fixed rate premium, so you don't pay more for having a fixed rate. And then we do rates on second charge buy-to-lets from 4.75% as well. Okay, what you do to get a rate is put the customer's details onto our portal. So to get a quick quote takes a few minutes, and it'll give you an ESIS and a rate for your customer as well. Turn the lights on. Okay, ERCs, then it's 5%, 4%, 3%, 2% in 1% in years 1 to 5 on all products, and you can charge a broker fee of up to £5,000 as a max. Okay, well, we offer 2 types of valuations to support the loan. So it's either an AVM, which you can do on most loans up to 80% LTV, or it's a full valuation. It's always a full valuation on a second charge buy-to-let. Okay, if you can't get consent from the first charge lender, so if there's a restriction on the land registry, you write off to the first charge lender and they say, no, we won't, we'll decline the consent, then that's fine. We'll still do the loan. We do something called an equitable charge, and we'll do that up to a maximum of 80% LTV for a 50k loan, or a maximum of 65% LTV for a 100k loan. Okay, so you just tick equitable charge on our portal, and then it'll go down that route for you. There's a 1% extra loading charge for the equitable charge, but we will do that for your customers. Okay, so some USPs just to cover with you. We now offer products up to 95% LTV for your customers on loans up to 200k. You can go higher than that. Like I say, if you need to get more than 200k, you can refer it via Tony's team, and we do up to 500k on referral. Okay, second charge buy-to-lets, then we're market leaders here with regards to LTVs and rates and things. So we'll go up to 90% LTV on loans up to 150k, and if you need more, you can refer it. So 90% on second charge buy-to-lets on the LTV, and 95% on the residential second charges. Okay, there are adverse credit plans available as well on all products and all LTV bandings. So we look after all types of customers. So they could be prime customers, mid-range, and then customers who have adverse credit. There's kind of a plan for all of those customers. Okay, so minimum property value as well is 75k. So as long as the property is worth 75,000, then it would we'd be able to use that property to support the loan. Okay, we also lend behind equity release mortgages. So I think we're one of the very few lenders that will do that. So you've got an elderly customer with an equity release mortgage, then they want to borrow some extra funds. Then as long as the LTV is below 55%, then we will look to lend to those customers as well. Okay. Again, no maximum age, but we do consider lending into retirement and whether the loan's going to be sustainable and affordable for your customers as well. All right, so with regards to loan purposes, we'll lend for any legal purpose. So if they want to buy a buy-to-let, that's very popular at the moment. We're getting lots of inquiries for buy-to-let purchases. We'll pay off tax bills. We do things like repaying an ex-partner. So any legal purpose we will do the loan for. Okay, with regards to property types, we do most property types, but we don't do HMOs. So if it's a home of multiple occupants, then we wouldn't look to do that. However, we'll lend to with regards to most properties. Okay, so just to recap over, for valuations, AVMs up to 80% LTV, max loan size of 75k there. AVMs, so electronic valuations, up to 65% LTV. We can offer a max loan size of 150k. Okay, so it's becoming a lot faster with us. Like I say, a lot slicker with regards to, you don't have to wait, a week or so for valuation to be done. We accept AVMs with regards to within that criteria. Okay, so income and affordability as well. That's now built into our brand new portal. That's really slick. So we will show what ONS figures that we're using on our portal, and obviously, you can go through that with your customer, make sure, recap over the figures and stuff, make sure, just check what they're paying. So affordability is built into our portal now. We'll accept things like overtime and bonuses. We do loans for contractors as well. So if they kind of sit in between self-employed and employed customers, often they're contractors. So we'll look at a weekly rate for those contractors and then times it by 46 weeks, and that'll give you the annual figure. Okay, just need a bit of information to back that up, like a copy of contracts over the last 12 months. Plus, we need to know that they've got at least 3 months worth of contracts still running, but we'll use contractor income. We do loads of loans for contractors. So we'll also do loans for customers on benefits, but they need to have some additional employed income as a household as well. So we won't do purely benefits, but if it's a combo of benefits and employed income, then we will look to do that. Okay, so buy-to-let second charges. we've introduced, again, using rental coverage. So you can either use a full I&E or rental coverage on a business buy-to-let, and you can use rental coverage up to 75% LTV. So as long as the rent covers the mortgage payment and the step one payment to 125%, then this is for a basic rate taxpayer, then we will look to use rental coverage, or you can do a full I&E, whichever you need to do, and we'll go up to 90% now. So it's a full I&E on anything over 75%, and on all consumer buy-to-let products, you do a full income and expenditure for your customers. Okay, so we'll accept second job income, and we'll do customers in probation as well now. So if your customers coming from a similar industry or similar skill set, they're in probation, then we will look to still do the loan for them. Previously we didn't, but now we'll look to do loans for customers in probation. 0-hour contract workers as well. We will look to do loans for those types of workers. We assess multiple pay slips, making sure that the income is sustainable and has been regular for the customer, and then we will look to do loans for 0-hour workers as well now. Okay, so with regards to credit, we don't do a credit score. We've still got plans where we offer customers loans who have got up to 4+ adverse units. So they might have missed mortgage payments, credit card payments. They may be in a debt management plan or an IVA, then we'll still do loans for those types of customers. Okay. With regards to debt management plans and IVAs, like I say, we'll consider those customers. You can leave a debt management plan running, so you don't have to pay off a debt management plan if it's the right thing for the customer, but you would have to pay off an IVA. Okay. Probably mentioned a couple of times, we have got the ability to lend outside of criteria. We are flexible. So if you get anything that sits slightly out of criteria, then it's worthwhile speaking to Tony's team, who will then get in touch with myself or our office, and then we can do things out of criteria if it's the right thing for the customer. Okay, so some technology upgrades then. So as I recently built the I&E into our portal. Previously it was a standalone I&E Excel spreadsheet. So it's built into our portal now, and we give you those ONS figures that we're using in the background. You can get e-sigs from customers as well, so they can e-sign documents. We always need a wet signature on the mortgage deed. And there's no valuation required products. These are going to be coming soon. So our system, our portal will do the valuation for you in the background and ultimately give you the thumbs up that you're not going to need a valuation. That's not live yet, but it's give you a little glimpse of what's coming in the future. Okay, we now also list all the documents that your customer needs on our portal in the documents section. So once you've done your quick quote, you'll get an ESIS, then you'll do your further AIP with regards to a bit more information about the customer. You'll do an I&E, and then it'll give you all the documents you need for your customer that we're going to actually require. They'll be on the portal as well. Okay, so ultimately a lot slicker. We've got some fantastic rates now, and so your customer's going to get a decision from us in a matter of minutes. And ultimately, hopefully it's the right decision, obviously, for your customer and something then they'll want to go ahead with. Okay, so to summarize, some fantastic new rates. So we're starting at 3.85% now on residential cases. We'll do up to 95% LTV for your customers, and you can do loans up to £500,000. So 3.85%. And it's up to 95% LTV now we do. On second charge buy-to-lets, so fantastic rates with regards to that as well. So from 4.75 on the buy-to-let second charge, and we'll go up to 90% LTV as well. Okay, we'll do loans for customers who have got CCJs, been in debt management plans and IVAs, and have had missed payments, and you're going to get a quick decision off your customers or for your customers from our portal. We've minimised the amount of documents as well from feedback. We've minimised the amount of documents that are going to be required as well. Okay, so thanks for your time, everybody. And if you've got any questions, I'm happy to answer those right away.
Thanks, John. We do have a couple of questions, or 3 questions actually. No, yeah, 3 questions. So Dilip has asked, as far as the purpose of loan, will you lend for business purposes?
Yeah, we do loans for business purposes. If it's anything quirky, excuse me, it's worthwhile referring via your team, Tony, and we'll take a look. But we do loans for business purposes.
Always best just to give us a call and ask. I mean, most business purposes are okay. If you've got somebody that is, I always think back to the client I spoke to many years ago who was a plumber, and he phoned me one morning. He watched Gordon Ramsay on the telly the night before and decided he wanted to stop being a plumber and become a restaurateur, and wanted to borrow money to set up his own restaurant.
Yeah,
with no, so he never even cooked. He didn't even cook. His wife done all the cooking because his words to me were, "Well, it looked really easy. Gordon Ramsay can do it. Why can't I?" So obviously that sort of thing you're not going to find a lender for. But most situations are absolutely fine when it comes to business purposes. Andy Virgo is actually our next speaker. So thanks, Andy. It's the first time we've ever had a speaker ask a question, actually, and all the ones we've done are these. So Andy's asked, on buy-to-let, can you provide a second charge to a landlord holding property in their SPV, or is it just held in their personal name?
Yeah, so it's got to be just in a personal name. So we don't do limited companies. Is that what you mean, Andy?
That's basically what he's asking. We do now have 2 lenders that have come to market that are offering exactly that. So they will lend on limited on buy-to-lets that are owned within an SPV.
Okay.
So yeah, that's not. But it's not something that Step 1 can do. William Curtin said, "Will you consider expats?"
No, they've got to reside in the UK and ultimately get paid, paid into a UK bank account in sterling and pay UK tax as well.
Okay. We haven't got any more questions. John, you've actually answered all the questions you set yourself. You've answered on your final slide, unfortunately. So I was just going to talk about the equity release second charge product you've got, because that is fairly unique. I mean, I was banging that drum for quite a while before you brought this out with various lenders, and they're all going, "Oh no, we don't know about that." To me, it absolutely made sense because the affordability is there straight away because there's no repayment on the first charge. The big obstruction was always you could rarely get consent on an equity release or consent from the equity release mortgagee. But that now we're finding some equity release lenders are granting consent. And if they don't grant consent, of course, you'll still do the equitable charge anyway.
Yeah, correct.
But that, I mean, just as, I mean, I'll be talking about opportunities in my later presentation, but this is an opportunity that you could just have in the back of your mind when you've got customers phoning you who maybe want to sell their property. You've got somebody who's, I don't know, in their early 60s, still working, got a decent pension in place, no mortgage in place whatsoever, but they've taken out an equity release because they wanted to, for example, get their kids on the property ladder or get their grandchildren, put their grandchildren through university. And we've got all these changes happening within happening to carbon emissions that I'm going to be talking about. And they need to raise some money and they want to get themselves, for example, a ground source heat pump, which at the moment is anything up to, I mean, the cost of one is anything up to 38 grand was the latest I saw. And that's without the actual fitting of the thing. And it's the size of a wardrobe. So as you can imagine, it's quite expensive to fit them. So if you've got somebody looking to sell their property, but they're currently sitting on a EPC of F, as an example, and they want to raise money to get the property done up so they can sell it, there is one good example of an opportunity. And this is a great product for that type of, that type of situation. So we've got no more questions. Is anything else you want to add, John, or because we're quite a bit ahead of schedule? This is good.
No, like I say, we are leading. We've got some fantastic rates now, so it's worthwhile. If you get anything or anything slightly out of our criteria, then speak to your team, Tony. And then, so obviously got a fantastic relationship with your guys there. So we do
certainly have. He mentioned his boss, Martin, who is what
your old friend.
His boss's boss, and Martin, who he said he's been around 30 years. It's actually a bit longer than that. It's actually 35 years. I first met him. First met him in 1987. We got on very well. I've got on really, really well. He's a Facebook friend, so he's not a work contact. He's actually a friend. Who,
Yeah.
when I see him, we have a beer together.
Good.
So if I have a situation where one of the staff says to me, "We've got this really difficult case," I'll phone Martin. Martin, what do you think? And he's very commercially minded. It makes sense. He'll look to do it.
Yeah.
Because he's got the experience to know when a deal is, if that client is likely to pay. Of course, that's what lenders always want to look for. And if he doesn't pay, will they get their money back? Right,
Exactly.
so that's it. So, John, thank you very much. IT team will remove you from today's session, or as a speaker at least. You can stay on if you want to. But thanks once again. We'll see you in a few months.
Yeah, thanks for your time, everybody. Thank you today. Cheers.
Cheers, John. Our last speaker, Andy Virgo from Lendinvest, a very long time supporter of our mortgage shows. He was actually, I believe, we started these in 2017, and I'm pretty sure he did the very first one, which was that hotel. So he's done loads of these since, loads and loads and loads. Great supporter of ours, lovely guy, and he's going to be talking about everything Lendinvest today. Andy was one of the people, right? Lendinvest, or bridging lender, if you know Lendinvest, a bridging lender for quite some years. And they wanted to launch into the buy-to-let market, and I've really got to say this was the slickest launch I've ever seen of a range of products within the buy-to-let market. It really was. It really was something new. Andy's going to be talking about all that today. You've received, Andy. By the way, can you hear us? I forgot to actually ask. And how are you?
I'm very well, thank you, Tony. Great
Okay.
event so far.
Found out towards the end of last year that Andy'd always lived on the south coast and decided during COVID, sod this, and he moved to Newcastle, of all places.
Absolutely.
So he's now a fully accredited Geordie. Have you got your Newcastle season tickets yet? Or
Straight away, first thing we did.
fantastic, great idea. So you should have received this from us this morning. You got the buy-to-let rates guide and the Epic Star rates guide. Both come over to you. A little bit about Andy, first of all. Joined Lendinvest in 2017 as BDM with over 30 years experience in the mortgage industry. He supported Lendinvest's entry into the buy-to-let market, including the development of its product proposition, and has assumed full responsibility for the product as a whole. Doesn't say it on this, but he's actually director of buy-to-let for Lendinvest now. So there you go. You've got a director talking to you today, all of you. So Andy previously worked for NatWest and InterBay, who presented earlier on, and successfully operated as a mortgage broker, both for Christie Finance and his own property finance brokerage. This guy really knows his stuff. So have a listen to what he's going to be saying. As we always do, we got his interesting fact. We did try and find a photograph of this as well, but unfortunately there is no records going back that far, because Andy was once a red coat at Butlins. He will not be doing a song and dance today as he's doing his presentation, thankfully. But I'm sure you had a great time doing that. I know people I know that are going to that have had an absolute whale of a time.
It was 1983. It was Easter 1983, and there was a heat wave, and they didn't have any lifeguards. And so a mate of mine's dad was the entertainment manager. So a mate of mine and we became lifeguards for that Easter couple of weeks, and I saved 3 people's lives, all of them female. None of them needed it. And one of them, their dad turned out to be the scout for the local semi-professional football team, Bognor Regis Town. And after chatting her up, I managed to get him to come and watch me play, and I ended up getting signed for a semi-professional for the local football team.
There you go. Something I didn't know. He was a semi-professional footballer. He's never actually declared that on any of these. So there you go. And all the ones he's done, never declared semi-pro footballer. There will be a photograph of him doing that, no doubt. We'll see if we can find it for next time. Andy, over to you. I'll see you in about 20 minutes. So good luck.
Thank you, Tony. And hi, everybody. And it was really interesting. I've joined this one from the start because I always like to hear what our peers in the market have to say. And what's interesting is Tony was saying that 60% of the people that have signed up for this are new to these events, which is a bit of a shame because I've taken the slides out that really position Lendinvest in the market. So, which is what I normally start off with. But so for those that are new to this event, some of you might be new to Lendinvest. So before I really get started, Lendinvest set up as a bridging broker initially back in 2008. Saw an opportunity in the what with the credit crunch at the time to start lending in the bridging market. Bought in development a few years later, and then as you heard Tony say, I joined with the view to bringing the buy-to-let proposition to fruition back in 2017. So when you think about Lendinvest you're talking about a lender that's amongst the peers of Precise, Fleet, Kent, Reliance, Keystone, Foundation, Paragon, Lambay, Zephyr, West One. So that's the market we're in. Those are our peers, and those are the businesses that if you're thinking about them, then come to Tony and speak to Tony about Lendinvest. So the business has grown over the last few years. 4 years ago, we had what they call assets under management. So like the investments that we controlled, £360 million worth of assets under management. We're not a bank. We're not regulated by the PRA. We're funded by institutional investment from some pretty significant players, including JP Morgan. And as of last week, we announced that our assets under management had risen in the last 4 years to £2 billion. So we're a significant lender. Our pipeline's 100,000% up. That'd be terrible. Pipeline is 100% up on where we were this time last year on the buy-to-let side. And whilst we do some bridging, I'm predominantly going to focus on the buy-to-let proposition today. So what I'm coming to you with to start off with is not so much really rate-led and price-led a sales pitch. I'm coming to you more with a sort of a thought leadership. This is where we see the market in 2022. So if you were asking us what's on our desk, what's on our mind, what's on the agenda for this year, we're focusing on these things, and that is predominantly the fact that 5 years ago the PRA made some changes to the underwriting standards for buy-to-let, and just prior to 5 years from now, the extra 3% stamp duty came in as well. So an awful lot of landlords jumped onto 5-year fixed rate mortgages 5 years ago. So where should your focus be? Where is our focus for 2022? Well, it's on those landlords that are coming to the end of their 5-year fixes. And we're going to talk about some of the things in a minute as we progress through this that are available to those landlords now that they didn't have available to them kind of 5 years ago. Also, as part of those changes, and whilst the government were having their little go at the portfolio landlord, and they were making it harder for people to make proper money out of their portfolios, there were changes in tax and taxation that were implemented and phased in over 4 years. So we still have some landlords that have significant property portfolios held in their own names. And those landlords are talking about incorporating, or now are getting the opportunity to think about incorporating those portfolios and moving them into limited companies. That's something pretty significant, and is a massive opportunity for advisors, brokers to pick up some pretty good business, because lenders are much more used to those types of loans than they were 5 years ago. There's the availability of longer fixed rate terms available now. You know, the buy-to-let market, I'll call a spade a spade. Precise launched a 10-year fix. They've tried it a couple of times over the years. It's never won friends and influenced people. I think that was timing, to be honest. Here we are at the moment with all sorts of concerns about the Bank of England raising the Bank of England base rate, and what does that mean to landlords and the future. And if you're a landlord that's not necessarily looking to gear up, then potentially you need to be looking at fixing for a longer term, which will show you some of those products in a minute. And of course, then landlords have really been rammed down their throats about energy efficiency, and we're going to talk about that, and the continued rise of the professionalism of landlords, and the fact that here's an opportunity for you to build relationships with people who are now maybe potentially more serious about buy-to-let than they were than some of those landlords going back 2 or 3 years ago. We have seen a lot of landlords exit the market as it's proved harder to make money unless you have sizable portfolios. So the professionalism of the landlord market is something that's very much we're aware of, and the amount of landlords that come to us and talk to us about what it is we're offering, the amount of events that we do where we're educating private landlords on Clubhouse and things like that, we're educating those landlords, hopefully for them to come to you guys and for you to liaise with Tony and his team at Specialist to access us to secure the buy-to-let products and loans that you need. So ultimately, let's talk about complex buy-to-let, because standard buy-to-let, the stuff that's done by the TMWs of this world, the BM solutions, that's all quite straightforward. But what about the complex stuff? So what is complex buy-to-let? Well, I've broken it down into 4 main sectors today because it's just a short 20-minute presentation, although I might run over soon as we're going a bit fast. Company structure. So we're going to talk a little bit about company structures and how lenders now are being able to kind of work with those landlords that tend to make it very complicated for you in terms of how they want to set up their portfolios and their limited company structures. We're going to talk about how people own their properties and the difference between a limited company and owning it on your own. Again, focus on the big green issue, and of course the property location, which is quite interesting. So keeping it quite simple, company structure, tiered ownership. What we're getting presented with as lenders these days are businesses that have been set up, SPVs that have been set up outside of maybe a trading business, outside of a holding company. And there's money moving around between those businesses to form deposits, intercompany loans, and those are okay. We're okay. We're able to understand, if presented with the clear picture, how these businesses are set up, and in the majority of instances, we're able to allow someone to move some money from their trading business into their SPV for them to go and buy properties to grow their portfolio. There are times when it doesn't make sense, when you have kind of like multiple people within the trading business, you're taking some money out of that trading business that doesn't benefit what you're going to do with that money, doesn't benefit the other parties in the trading business. So we do like to see some alignment of ownership. But each case on its individual merits. We're a specialist lender. We manually underwrite, although we have very automated processes to get the deal in, very quick, very slick. But actually, when it comes to the underwrite, we're able to really get under the skin of how companies are set up and more often than not facilitate moving of money around. So whether you've got a tiered ownership, a holding company, whether there's associated companies, whether you've got multiple SPVs, whether you're moving money from one company to another, those instances are fine. And let's talk about incorporation. So, there are a lot of landlords that are coming to the market at the moment, or having, as I said, 5 years ago, locked into a 5-year fix. They've not been able to do anything with their ownership structure. They're looking at now incorporating their portfolios, and there's something that's reared its head called beneficial interest trust. It's quite a specialist subject, and one that it's one of those things that, oh my God, why have I raised this? I'm going to walk into a bit of a minefield here. But a beneficial interest trust setup is kind of in the situation where somebody might own the property in their personal name. They might set up a separate company to take hold of or to collect the rents for a couple of years. And then if they can prove to HMRC that it's a sizable portfolio, then there are certain benefits and tax savings to move the property into the new SPV. I'm going to come on to this in a little bit more detail in a moment, but my message is we're okay with those instances. We understand, we can get to the bottom of why people are trying different ways to move property into the best vehicle possible to own it from the best tax position possible. The point we're trying to make is we just need to understand the whole deal. As InterBay said, as everybody said all the way through, we're very much into tell us the facts, we'll understand the deal. If it makes sense, if it's not likely to be unwound by HMRC in the next 3 to 5 years, then it's something we can assist with. Moving on from company structure, you've got these ownership vehicles, and I'm going into this in a little bit more detail now. So let's assume somebody's made the decision to move to an SPV. There's an awful lot to consider. In the short space of time we've got to go through this now, I'm only going to touch on a few kind of tidbits here. But ultimately, what's the benefit of moving a property from a sole trader to a limited company? Well, potentially, there's tax relief on mortgage interest, which it enables a limited company to pay less tax when it comes to corporation tax than it does for a portfolio owned in a personal name. The tax on the profits is lower. You can transfer the ownership around your family by bringing in new directors, new shareholders. Ultimately, that can improve or make things easier from an inheritance tax point of view, or future planning the ownership and the managing of your portfolio. And of course, then when it comes to coming to lenders, it's very much easier for us to underwrite often or there's increased credibility when it comes to a landlord who has shown the ability to manage their portfolio in a limited company, because ultimately, it can allow you to come to us and gear up on your security to raise money to grow that portfolio. So with all those properties in a single portfolio, you can potentially expand your portfolio more quickly. There's always a but, and that could be some of the associated costs involved, the reporting duties you have to take on board, things you need to consider around engaging with an accountant. And then if your particular model is that you want to bring cash out of your portfolio, you want to take it out as dividends. If you are releasing equity and you're taking out as dividends, then it can actually be less beneficial from a tax point of view. Now, this is in no way, shape or form a lesson. It's a massive subject. And none of us, not us, not Tony, not anybody listening, watching today, should be advising anyone on how to manage their portfolio and which direction to go when it comes to the vehicle they use. If there's one piece of advice, if you haven't done it already, a takeaway from today is to link up with a tax consultant, an accountant of worth, of knowledge, and work with them to make sure that they are the ones providing the advice to the client, to the landlord, on what is best for them in terms of how they're going to manage their portfolio moving forward. Everyone's got different motivation. Different people are in it for different things. There's not one size fits all. And none of us sitting here today know the answer. It needs to come from a tax consultant. So do not give advice. Link up with a tax consultant. In terms of location, we get sent, I think probably one of the things that the BDMs probably get the majority of inquiries for each day is, would you lend on this property above a shop? Would you lend on this property in this commercial area? We've got a property that's next door to a pub, next door to a church. It's quite rural. We look at those properties, and one of the things, or the two things that we really want to understand is, should something go wrong, what is our ability to sell that property? Is the property marketable from a sale point of view? Is it marketable from a lettings point of view? Is it lettable? So what's someone's desire to live in a flat above a kebab shop that's open until 2 o'clock in the morning? Probably very little. Don't get me wrong, there are people that do live in those premises. It's just not something that the situation that we're in as a lender, the way that we've positioned ourselves, that's not the type of property we lend on. That's something that you'd be speaking together about, or speaking to Tony about, and he'll have multiple outlets. So when it comes to commercial areas, absolutely fine with those commercial areas. Our proposition has evolved over the years, and what potentially 4 years ago was something that we were a little bit skeptical about, now is something that's a little bit more bread and butter as we've evolved, as we've learned, as we've managed to kind of keep an eye on our loan book. Something above a pub, no way. Something next to a pub, perfect. That's again, if the surveyor goes out and says the property is lettable, is mortgageable, it's marketable, and if someone wants to live there, something along those lines, typically London, close to a tube station, why not? I'll be quite happy living on the one above the kebab shop myself. Rural properties, if you've got small areas, conurbations outside of a town, of a city, something that's commutable to from sort of like the hospitals, for argument's sake, the universities, the hospitals, the significant employers. if something might be a little bit rural, but it might still be within a decent distance to a location where there's employment, so the property is lettable. If you've got a farmhouse in the middle of nowhere, in the middle of Wales, in the middle of Scotland, what's the chance of finding a tenant for that type of property? So that's how we look at it. What is it that's going to drive the appeal for that property? Now, historically, funders have struggled with where a landlord lives in a block, and there's blocks and there's blocks, a block of flats and there's a block of flats. If there's 2 or 3 units and a landlord lives in one, that's probably a bit of a problem for us. If we end up trying to repossess one of the flats, the landlord could end up frustrating the sale. But if it's 20 units, 15, 20, 10 units, a sizable number of units in a block and a landlord lives in one, that's not going to be a problem. High rise is a problem. There are some lenders out there, you can go to Lendinvest and or West One, and they'll do multiple properties in a high rise. So we'll do up to 10 floors up to 10 stories in London, 5 stories outside of London. High rise isn't for us, and concentration, big concentration, lots of flats in a block, that's not for us. And of course, then there's next door to your own residence. Whilst you get so many landlords come to us and say, do you know what, I want to buy next door. I think it's really good. I can manage the property. Who wants to live in a buy-to-let when the landlord lives next door? It's not necessarily good business. And when it comes to what's really making the press at the moment, it's about the EPC, and everybody's trying to drive towards the 2050 aim for zero emissions. Now, a little bit of inside information here. All of us lenders are looking at the EPC certificate at the moment. We've got green products. And when you look at the EPC, we look at the environmental impact rating on the left there, EIR, the environmental impact rating. But what's coming up soon, and what you're going to find creeping into to lenders' requirements, is also a measure on the environmental efficiency rating. So it's the carbon footprint of the property. Now, this is a second rating that a lot of lenders with green products have ignored and not taken into consideration when it comes to, do you qualify for a green product based on a decent energy efficiency rating? Because you could have a good carbon footprint and a poor environmental impact rating. You can improve your environmental impact rating, improve your EPC rating with windows, with changing your gas supplier, with insulation, with putting an electric charger on the outside. Tony said, I've just moved to Newcastle. I've bought a 3-bed detached. Won't tell you how much. I'll make a lot of you sick if you live in the south. It's very inexpensive up here, but it's got everything. It's got great windows and electric points in the garage, and the EPC's rating is B. To get to an A, you'd have to put solar panels on the roof. So we'll lend where there are EPC ratings of A, B, and C, but watch out, because you're going to start having to ask a question around the carbon footprint as well. If you look at sourcing systems at the moment, you've got Trigold. They've said they've got a filter saying, is your property green? Yes or no. Whereas you look at 27 Tech, they're saying is part of the filters, what's your EPC rating? So another question to be asking in your fact find now is, what is your EPC rating? Because there's some pretty significantly reduced products out there for people with decent EPC ratings. And that's what we've called our EPIC range, a little play on the word EPC, EPIC. So if you have a property with an EPC rating going from C up to A, you can reduce our standard rates, our interest rates, by 10 basis points, and we'll reduce our fee by 25 basis points. That's available across all of our products. Now, what's really important is people also look at, okay, well, I've got an existing buy-to-let, but what if I'm buying something and I'm improving the EPC rating? Well, we've launched something called Epic Star. We were going to call it Epic Plus, called it Epic Star. And Tony sent you the details on this. So if you come to Lendinvest for a bridge, and in moving the property from an EPC rating below C to C or above, then not only will give you the fee discount as before, but will actually reduce your buy-to-let rate by 20 basis points, not 10 basis points, should you exit to a Lendinvest term loan. So come to us for the bridge. We've got an online bridging proposal now for unregulated bridging, and you can go from you can go through it in 10 clicks to get a formal offer and to get an offer. And when you exit to a term loan, having done the work, you can offer your customer 20 basis points discounts off of the interest rates and 25 basis points off the fee. Now we talk about, I said I'm not going to talk about interest rates. The sourcing systems will sell interest rates, BDMs, and these are the events where you talk about criteria. And criteria is where it's really at. But when it comes to interest rates, we're there or thereabouts when it comes to being on the right page on the sourcing systems. We haven't reacted to the current war that's going on, where some pricing has been dropped by some lenders. I hold my hands up and say we're super busy, and it's not a time for us to be going after even more business based on we're doing so well. But also, we don't want to be introducing lower interest rates only to have to increase them in the future because of the Bank of England base rate change. Now, we don't have any tracker products yet, but so our cost of funds are protected somewhat. So you'll probably see quite a stable position in the market from Lendinvest. We will, from time to time, look to position ourselves top of the sourcing systems, but ultimately you should always see us around the second or third choice lender. We lend on standard buy-to-let properties, we lend on flats, we lend on flats above commercial, as I said. We don't offer semi-commercial mortgages. Don't tell anyone, but watch this space. Now, you could be looking at, as I said, flats above commercial, you could be looking at multiple flats in a block. We'll also fund HMOs, which I'll come on to in a second. But I did allude to the fact that the Bank of England base rate's going up. So we bought out our 7-year pay rate product. Now, the 7-year pay rate product is probably now our best selling product. It's up to 45% of applications. So those landlords that are out there not looking to necessarily gear up, they're looking to stay in this for the long term. They're looking to hold on, have some stability. They're looking to keep coming back to raise more and more money as the property prices grow. We're forecasting property prices to go up by 2% this year. So there might not be so much equity for people this year as there was last year. But the 7-year fixed rate, we appreciate you know 5-year fixed rates are tough enough for you guys to get some repeat business out of landlords. So our 7-year fixed rate comes with a 6-year ERC. So they can stay with us for 7 years, but if they want to remortgage a year early, then that's fine. We don't have any early redemption charges in the 6th year. The interest rates are from 2.88. You know, 2.88 at 70% loan to value for a green 7-year pay rate product with a 1% fee. I mean, that's why this is flying off the shelf. 2.94, 7-year fixed, 75% loan to value. This is a phenomenal product. We entered into the holiday let market last year. Holiday let market's really an interesting one because you've got the Cumberland, you've got Hodge, you've got Furness. They look at valuing, and also perhaps Shawbrook and InterBay. They look at valuing the holiday let on the basis that you look at the rental income as a holiday let over 26, 30-week period. We value it on a buy-to-let basis. Now, I won't say that we're going to be pricing these as buy-to-lets, but watch this space. But at the moment, the pricing for holiday lets is akin to our small HMO proposition. But we value them as, and we consider them as standard buy-to-lets, and we charge £150 val fee. And the interest rates are all sub 4%. So it's really well priced. And with the boom in holiday let products, with holiday lets in the UK, there's a consideration that this actually might be a very prudent way of valuing these holiday lets. Valuing the property on the assumption that if it can't be let as a holiday let, it'll be let as a buy-to-let. Some of these landlords that potentially have geared up based on the rental income that they're going to achieve as a holiday let. what happens when an area is overpopulated? What happens when this rumoured regulation comes in about the holiday let market? Are they going to be are they going to be in a negative equity position? Are they going to be selling their properties? They're going to be looking at renting them as standard buy-to-lets. Will the serviceability cover the mortgage they've got that they need to replace? There's an area in Devon, I think it's North Devon, I read, where there are something like 153 Airbnb adverts out there currently, and only 2 long-term buy-to-lets. There's an area on the Isle of Wight where 85% of this particular village is second homes. So it's not going to take too long before local councils are going to get to government, and this kind of rumoured regulation of the holiday let market and having a register of holiday let homes is actually going to happen. So we're quite happy how we're valuing these. We're quite happy how we're pricing these. And of course, the benefit to the customer is that £150 valuation fee and sub 4% interest rates. I talked about HMOs. We split our HMOs into 2, small and large. So our small HMOs up to 6 letting rooms, we value those on a vacant possession basis. Happy to allow student lets. But when you get to the larger HMOs, and there's not many specialist lenders. Yes, you've got the commercial lenders, the Shawbrooks, Hampshire Trust, your InterBays, they'll do the large HMOs and they'll price accordingly. But up to 15 letting rooms, there's only 1 or 2, there's two of us, 3 of us that'll go up to that number. I think Foundation are up to 10, Lambay are 1, that'll go up to about 14, 15, I think, historically. But the most important thing is that we would value a large HMO on an investment basis. Some people call it investment, some people call it long form, someone call it a commercial valuation. Ultimately, it's a RICS valuation. So on that basis, we'll also lend on the multi-unit freehold blocks, up to 10 units. That's something that's quite popular for us. And then from a criteria point of view, we've made many changes. We're on lending policy number 6, which has just gone to our funders, where we've increased our maximum exposure per client. So there's no minimum exposure limits. So we're happily lend above £3 million per customer at 75%. We've even looked at some for 10 or 12 million. We've got no postcode exposure limits. We've reduced the requirement on CCJs. And just one thing before I finish and go to questions. At a time when there's pressure on tenants from an income point of view, at a time that there's pressure on them from tax credits, universal tax credits are reducing. You've got increase in energy costs. Are landlords able to secure from their tenants the type of rental income that they've been used to achieving in the past? We lend based on the market rental income. So a valuer will go out, they'll give us the market rent. You could have a £1,200 a month market rent and you'd be receiving £1,000 a month rent. We will lend based on the market rent in that instance. So on that basis, we've got quite a strong proposition. There's an awful lot more to it than I've been able to squeeze into this short presentation. The most important thing today is to say, speak to Tony, speak to Tony's team. You do not lose out by way of a proc fee. You'll get exactly the same proc fee as if you came direct. The benefit is that Tony deals with us day in, day out, week in, week out, knows our quirks, knows our processes, and will be able to smooth that process for you and help you achieve all of our goals, which is to lend money to our fantastic clients and make money at the same time.
Absolutely. Andy, thank you very much indeed. A few things that I learned that I always say, it doesn't matter how long you've been in this business, every day is a learning day. There was a couple of things in that I didn't know, so I'm going to be doing some reading this afternoon when I'm eating my lunch. We've had a couple of questions from delegates. So Shazad has said, would you lend on standard construction apartments in a 5-storey block but without an EWS1 report?
No, we need to follow the RICS guidelines on the EWS1 issue. There's no circumventing that. So no, we do need to follow the guidelines. If an EWS1 is required, then we'll need it. If it isn't required, then we don't need it.
Okay. Paul has asked, what is the minimum square foot per unit on a multi-unit freehold block?
30 square feet.
Fairly standard. We've got a couple of lenders who will look at stuff under that, but it's fairly standard amongst lenders at this moment in time as 30. Someone is typing something, but it hasn't come up yet. So I'll ask you one that you actually set yourself. Lendinvest floated on the stock exchange last summer. What impact has that had on the business?
Yeah, so it's been a long-term goal for us to float on the stock exchange, and we did it last summer, June, July, and we raised £40 million from that flotation. Now we've invested all of it, and I mean all of it, into tech, into our tech roadmap. It's allowed us to accelerate our growth. And on that basis, we are launching specialist residential at the end of the year. Very much Kensington-esque. We're building the portal at the moment, all our own in-house technology. Our buy-to-let portal is extremely good. It's not our own, it has limitations. So we're building our own specialist resi portal. All the money's going into that. So by the end of the year, you'll see that specialist residential. And of course, then we'll be able to move our buy-to-let portal into the same guise. So we'll have bridging, regulated and unregulated bridging. We'll have buy-to-let and we'll have specialist resi, all in one portal. Very slick, very good.
Excellent. Wayne has asked, we make this the last question because we've just got about 50 seconds. Wayne has asked, can a landlord hold a holiday let in a limited company?
Yep.
100%. In a
100%.
nutshell. Yeah. Okay. Andy, great as always. Thank you so much. Look forward to catching up soon. I've noticed there is a little bit of a twang of Geordie in your voice now.
Why
I've known you for many years. So next time I speak to you, no doubt you'll be full on Geordie, and maybe have to come with subtitles, who knows. I do have one friend who's been living up in Durham for years, and he was from East London, and you wouldn't believe the change in his accent. It's just it's now, you wouldn't think it's the same person. You really wouldn't. But lovely to see you again, mate, and we'll catch up soon. Come and see us.
Will do.
My part, I will probably rush through a bit of this. There are some new slides in this, so forgive me if I look at them thinking, right, what do I need to say? Because I've written these over the last few days. But this hopefully will just give you a little bit of information about us, and my clicker's working, which is good news, about us and what we can offer you. There are a lot of new people here today who've never ever probably seen me present before, so you don't know who we are, you don't know what we do. We could be the biggest bunch of crooks in the industry, as you know, could well be, who knows? There's plenty of them out there. So we always start a little bit on the compliance side, just to let you know that we actually do know what we're doing when it comes to compliance. We've got our next NAC compliance visit is actually next week. And I don't expect any difference in the outcome because we've improved all our systems over the years. But this was the first one we had. All NACFB members have to have a compliance visit. We was one of the last ones in 2017 because we're S in the alphabet. So a guy came and saw us, basically said, I won't read all of this, but just the part highlighted, I do not see what you do as moving the goalposts, more a case of better than best practice, particularly considering the resource you have available. So very well done. He verbally said to me, you are the best by a country mile. He said there's companies out there who've got more people in their compliance department than you've got staff, and they are nowhere near the level you are. That's because we take it seriously, and that's because we know what we're doing. And we like to think we know what we're doing, but people tell us we know what we're doing. We had that one 2017, just before lockdown started. We had another one, this time over the telephone. This one, quite simply, we identified no gaps in compliance regulation, identified areas of best practice, notably in anti-money laundering and data protection controls. Again, something we take very seriously. If you're passing your client's data on to us, we want to ensure that no nasty little hacker based God knows where can get their grubby little mitts on it and do something with it. I say we've got our next one next week. So our next presentation that we do next month, there'll probably be a third one, but it's something we take very seriously. And we are told, well, I've been told that if the NACFB had on their daft awards dues they have every year, rather than having the best broker, they have best compliance, we would win it every year. That would be a good comparison, wouldn't it? Because that's actually something you can compare. So this is what we offer. We offer a partnership. The one term that you'll come across quite often is the term master broker. Absolutely despise the term. Always have done. And I will never use it in our business. You are, if you are passing your client's details on to us so that we can assist you either in packaging the case or you want us to give the advice, it's a partnership. It's your client. And therefore we treat it that way. So it's about two entities trusting each other. We have to trust that you give us the right information. Don't tell us a pack of lies. Which does happen occasionally. Don't try to hide stuff that is going to come out eventually, but sometimes doesn't come out until right towards the end. Also, you have to trust that we say we're going to pay you when we do. We pay on the day of completion, and we'll cover that later. And that we have the resource to do what we say we're going to do, which we absolutely do. We want to help you grow your business. It doesn't matter what your FCA status is. If you're DA, absolutely choose where you give the business. Appointed representatives, obviously, it's slightly more difficult. You're restricted sometimes by your network. If you like what you've heard today, and I did have a list actually somewhere of all the networks. I had it on my screen, so forgive me, I think it's just clicked off. There it is. So if you're part of Best Practice, Connect, HL Partnership, New Leaf, Open Work, Quilter, Stonebridge, Tenant Lime, Online Partnership, Right Mortgage, or the White Church networks, contact and you like what you've seen today, contact the powers that be, because we are writing to all of them. Our goal this year is to get on the panel of a number of networks. We've done it before, haven't done it in a while. We was the only company on the Millfield network for something in the region, I think it was 7 years eventually. That eventually became Hollister and then went bust in 2012, but we were their sole provider. So if you like what you hear, either make contact with the people that you report to, or let us have their details so we're contacting the right person. If you're an exempt professional, obviously no problem in taking business. We give the advice. If you're not authorised, it does become more difficult when cases are actually in regulation, because our PI cover now, it's the same for most companies. Your PI cover does not cover business introduced by a unauthorised person if that business is regulated and we're paying you something. So just be aware of that. Make sure you stay compliant and informed. One reason why we do these on a regular basis, and you're writing business indefinitely, there's nothing worse than having lots and lots of lenders but no one to give you business, or which isn't quite as worse if having no lenders and lots of people giving you business, which is what we had all those years ago. And our industry is terrible at keeping people updated with the changes that affect us all. We rely on the financial press, which sometimes really aren't fit for purpose, and quite simply because the FCA and the ICO can't communicate properly. It's as simple as that. I'm going to talk a little bit about GDPR. I really am probably thinking I need to stop talking about this, but it does worry me that with some people still aren't aware of certain things. It was brought in by the EU to make it difficult for the Facebooks and the Googles of this world. And we then found that all those American companies were setting up offices in Germany and Belgium and places. Just obviously that's what it was all about in the first place, all about the money. But over half, this was back in, I couldn't find anything more up to date on this, but back in November 2019, over half of firms still not GDPR compliant, and quite a big chunk had done nothing at all on it. Not a problem, because in general, the general public couldn't care less about GDPR. All they want to know is, I want to borrow some money, how much will it cost me, and when can I have it? They don't care about ticking boxes, about doing, all the things that the powers that be believe that are so important. It might be important to them, but they're not important to the general public. How much will it cost me? How long will it take? When can I have it? So it's really something. It's something that's there. It's something we have to adhere to. It's not something we take a huge amount of notice of, unless, of course, a problem occurs. Now, this is an example of the ICO came out with something. This was back in 2019. I haven't checked to see if they come out of anything since, because I do actually have a life and really couldn't be bothered. But it was 318 pages long. What on earth are they thinking, issuing something that's 318 pages long that no one's going to read? That's a book, for goodness sake. No one's going to read that. So what we decided to do was I stumbled across this on the ICO website. There was actually a checklist, which was very useful because it covered all the things. You remember back 2018, everyone was being told, you must be GDPR compliant. No one was telling you what you actually needed to do. There was nothing out there at all, unless you went to all these consultants who were then charging $1,000 for a seminar that didn't really actually teach you anything at all. So we found this. All I did was copy and paste it from their website, stuck it into a document. I completed it myself, signed it, dated it, scanned it, filed it away somewhere. And as far as I was concerned, I've got some proof. I then realised this actually might be a good tool for, obviously, our business partners, that if they haven't got anything in place, so this has been sent to you on email today. So if you haven't seen this before and you haven't received this before, by all means, grab it. It's still got our old branding on it. That's how old it is. Grab it, just complete it, tick the boxes that apply. If there's anything you think, I didn't realise I had to do that, you can obviously cover it. Then you can at least prove, if anything goes wrong in the future, that you were actually taking GDPR seriously, whether you were or not. You can actually demonstrate that you were. Okay, just make sure you keep it somewhere safe that you can find it. Then what we did was afterwards, the ICO came out with an annual assessment. This is half the size of the previous one. Again, you got this on email this morning. Print it off if you haven't done this before, and it takes 3-4 minutes, literally. I couldn't tell you what one question on there is because I really couldn't care less. But I just do it. It's the old tick box exercise, isn't it? We're just doing it so that if something does go wrong, FCA walk in and say, we want you to demonstrate how you're compliant with GDPR. I can go, there you go. Look at these. And they go, oh, isn't that wonderful? Okay, so you've actually got something that you can use should you need to. When it goes wrong, it can go badly wrong, because if you were to be hacked, for example, that's when you'll have the ICO and the FCA crawling all over you, because all they can see is fines. How much money can we actually extort out of this company because something went wrong, because someone clicked on an email that they shouldn't have clicked on, for example. That's when you need something in place. There is some good to come from GDPR. For years, lenders have been nicking business from us without our consent. We've all come across this. I come across this every single week with a lender going behind our back, trying to contact somebody, but it's less than it used to be, a lot less than it used to be. Just make sure your customers, to stop them doing it, just make sure your customers do not opt in to marketing permissions. Still a load of lenders actually ask customers to opt out, which is should not be the case, but just make sure they don't opt in with their permission. And here's an example. What we do now is that, because most customers will actually send back the lender's privacy notice, and they won't have ticked any boxes at all because they've probably not even read it. They look at the front cover, get bored by the time they've read 3 lines, go to the back, sign it, and then they chuck it back to us. Just make sure that they're not then going to be nicked from under your feet by the lender, offering them all sorts of products in the future. By just make sure they do not opt in. But right across it as well, because I've known lenders that have actually ticked the boxes when they've had the form. That's how naughty some lenders are. Right across it, no marketing contact. If you don't, you're going to get this sort of stuff. And this is way, way before. This was a client we did before GDPR came out, and it basically was obviously it was opting out at that stage. This client now, the lender's done this on numerous occasions for clients from that time. They don't do it on clients that were post May 2018, but anything pre May 2018, they're nicking business off us because they contact clients offering them further advances. But stupidly, they then send us a commission report telling us that they've done another advance and we're earning bugger all from it, just to rub salt in the wounds. So and this is fairly ongoing, and it's wrong. It really is wrong. Worst, actually, just before I go on to this slide, the worst example I had was a lender that phoned one of my clients that we completed a buy-to-let for, and on the day of completion, they did their normal courtesy call to welcome them to as a customer, and said, next time you want to borrow money, contact us direct and we won't charge you a broker fee. Honestly. Okay, I always just put this in because a lot of people aren't aware of this. This is the laughable, because obviously the ICO love to find organizations if they've been hacked. Well, the ICO was hacked themselves back in 2018, just before GDPR came in. This one was to actually spread basically Bitcoin type malware. Of course, no one lost their job, no one was fined, nothing at all. It was hushed up. There's very little about this on the internet. I've screenshotted everything, so I've got proof, because it tended to actually disappear after a while. But they were hacked. So the regulator that regulates data protection was hacked. Couldn't make it up. Then we found this recently. This is the shameful. If you want some free data, just go on the ICO website. And if you look carefully enough, you can download all 1,048,000, and this was obviously as of about a week ago, 575 rows of data that's in a CSV, like an Excel type CSV document, that contains personal information on every single one of you. Now, we've opted out on this on things like our email address, but there's 90,000 email addresses in there. So if some hacker decides, okay, we can maybe, our next one, let's maybe target anyone who's registered with the Information Commissioner's Office, because we've got that data readily available to us, because the ICO actually publish it. I mean, how ridiculous is that? I mean, why? Why would that have to be available? It's great that you can go on the ICO website and just check that someone has registration, which we do on a regular basis. But why do I need to download over 1 million records? I don't. No one does, unless they were trying to do something a bit dodgy. Let's face it. So that is an absolute disgrace. And that, I checked, it was still up yesterday. So if your information's on there and you're not happy with what it's showing, then maybe just put a complaint into the ICO. Maybe they'll get rid of that before loads and loads of people all of a sudden start getting ICO emails from some hacker in North Korea, which is probably what will eventually happen. And then they go, oh, sorry, we didn't realize that was up. So EPCs, Andy's already mentioned about EPCs. We know there's some changes. June 19, we passed, there was not we, but the government passed into law legislation, or basically there were some targets regarding emissions, trying to bring it to net zero by 2050. I won't read through all of this because obviously the print is quite small, but the changes, obviously, they're now kicking in. The law, it's now going through Parliament. It's expected probably by later on this year. But from 2026, all new tenancies of the EPC's got to be A, B, or C. 1/3 of landlords are not confident they can get their properties up to this new requirement. So what they're going to do? They'll have difficulty selling them as well. So there's one issue. And then for commercial, apparently, again, this sort of stuff is difficult on the internet sometimes because you're going by what someone else thinks the laws are going to be rather than what the laws actually are. But 2030 for commercial investment property, and completely decarbonise that UK housing stock by 2050 is the target. Will it ever happen? Probably not, but that's their target. And it will happen in all property transactions. So it's expected remortgages, product transfers, second charges, EPC must be at the rate required. What they're doing on residential property, I couldn't find anything yesterday whatsoever. But I'm going to keep searching until I find something to see what the rules actually might be. I shouldn't expect it will happen in this government at the moment, because that's the last thing you probably want to bring out when there's a general election coming. So there is a bit of an opportunity, obviously, with this coming up, because a lot of people have to improve houses. And so let's see what there is there. So, for example, ground source heat pumps, anything up to 35 grand, air source up to 18 grand. Prices will come down as they become more sort of like the more of them are made. Estimated cost for 100 billion. Now, where are people going to raise that 100 billion from? Government's going to fund some of it, of course. And there'll be various grants, but normally the grants, a third of what's needed. So if you've got that person who needs to actually get a property up to a particular grade, how are they going to raise the money? Well, that's where you come in. And Andy's already mentioned, actually, I do expect a stack of green bridging loan products. I mean, I haven't really seen any so far, but I'm expecting a stack of these where it'll be bridge to term. But they'll call it green, or as Lendinvest have called it, epic, which I think is a great name. But expect loads and loads of those to come out, because this is going to be a big market over the next, well, certainly in the next 3 years that I can see. A big market, probably 4 years actually. So be prepared for it. Speak to your clients. Okay, so what we can offer you, I'm just going to take a quick sip. Okay, so our products, this is basically what we're involved in. So regulated mortgages, regulated second charges, bridging commercial. We've added invoice, asset and supplier finance to our portfolio, and unsecured business loans. The only thing we don't really touch is equity release, because it's not a market I want to get involved in. We don't get involved in any pensions, investments, anything of that nature. We are authorised to offer general insurance, but it's something we rarely do because we only actually have it in case our introducer doesn't, and then because we want to make sure obviously the client's got insurance. But that's basically what we do, and our service is either packaged, you give the advice, or introduced, we give the advice. Very simple, very simple. My staff are experienced enough to offer both. We're not a company that's set up as a packager and has then decided to go into actually offering advice and the staff haven't got a clue. My most experienced member of staff, the most experienced member of staff has been in the market since 95. The longest serving with me is since 97. So they've got the experience to do both and can switch between one and the other very easily. Why are we different? Not the products we offer. I offer the same as every other company out there who's got the word specialist in their name, and there's loads of them. There wasn't in 2004, which is why I called it Specialist Financial Services Limited. Now every has a specialist in their name, which diluted our brand slightly, unfortunately. But we're all exactly the same, really. We all offer the same products, pretty much. Occasionally we get exclusives, semi-exclusives. It's all about people. It's the people we employ. The people we employ. Now, when I advertise a job, they can't even walk through the door unless they've got 5 years specialist financial services experience, not working behind the counter at Nationwide. They've got to have had experience in our purely because I don't want to be babysitting somebody and training somebody from scratch on products that all their colleagues know inside out. We now have staff that are multilingual. I'm not going to try and pronounce these because I can never pronounce them properly. So, but you can obviously read what they are. The major thing, mature life experience. I don't employ people that are just out of school, university, mainly because of the 5-year rule, but also because that even if they've got 5 years experience and they're say 25, have they got any life experience? No, none whatsoever. And my youngest member of staff, I believe, is in their mid-30s now. Most of my staff have children. They're in long-term relationships, and they're people you can actually have a conversation with, and also a bit of a laugh with as well, because let's face it, financial services isn't the most interesting of subjects. So as you might have seen by the way we do these shows, we do like to try and bring a little bit of humour and enjoyment into what we do, because otherwise how boring would it be? So mature life experience, absolutely vital. This was feedback given by, now he actually gives me the same feedback now every time I speak to him. I spoke to him yesterday and he said it's almost exactly the same, but he was actually talking about one particular member of staff. But he said all the way back in July last year, every member of your staff that I speak to is incredibly knowledgeable, polite, and looks to find the best deal for my client. You can tell they've been working in the industry for a long time and they really know their stuff. Every client I passed over to your company has raved about them. Now he's on a mission now to try and get as many people using us rather than others because of the way we work. Because we haven't got a huge marketing budget. We're a family-run company. We haven't got massive backers, anything like that. So we're not out there in your face, all the time, every time. We're slowly growing, and that's the way we want to keep it. But he's introducing as many people to us as possible. He honestly can't. If I had him here, he'd probably be pushing me out the way to tell you how wonderful we are. Why we're different lender relationships, because I've 38 years I've now been this, actually it'll be 39 this year, that's really frightening. So it'll be 39 years in September. I've been in the marketplace. A lot of the people that I first met when I came into the industry all the way back in the 80s are now at fairly high levels. I use Mark Goldberg as a good example. You know Mark Goldberg from Together. Mark, when I first met him as a BDM, soon after he was taken on by, what was at that time, Remain, full head of hair. He was in his 20s, fairly raw. Mark's now, I think he's number 2 within Together, and someone whose friendship and relationship I value greatly, because it's over the years we've helped each other out tremendously. So lender relationships. I mentioned Martin Porter at Step 1, known him for years and years. He's a Facebook friend. A lot of these people are Facebook friends. Not I spend a lot of time on Facebook, but as an example of the sort of relationship we've got. It's how seriously we take compliance. And we do take it very seriously. And the prevention of financial crime, we don't get a lot of financial crime. During lockdown, we had 3 that we identified fairly quickly and reported them to Action Fraud. And on all 3 cases, even though we gave them lots of evidence, Action Fraud said they wouldn't be taken any further. But at least we've ticked that box of actually reporting it. And it's not our numerous awards in the financial press. I mentioned, those of you who've watched these before know what I think about the awards system in this country. I just find for lenders, fine. We can all vote for lenders. We all deal with different lenders on a regular basis. But how can anyone vote for one particular broker as best broker? They can't. Unless you're big enough that you can use half a dozen brokers. Where do you get that comparison from? I've never put myself up for an award. I've never been asked I've actually been asked to actually go for an award, but then you believe it or not, you have to pay some of these firms to do that. You also have to pay if you win the award, you then have to pay to use the logo in your marketing. It's about as bent as it gets, unfortunately. And this is the sort of thing you're up against, because this was only last year, £250 Amazon voucher for this guy's Facebook friends if they voted for him and said they voted. Honestly, it just beggars belief that this is still going on. And these people still actually think they're the best broker because they won the award, when it's actually all their Facebook mates and Twitter mates that have voted for them. It's just laughable. So lenders, absolutely. When it comes to, you see a broker that's won 78 different awards over the last 10 years, I should ask yourself the question, how many have been paid for and how many have they been asking their mates to vote for? Because it's about as bent as it gets. It really is. I mean, some of the stuff we've seen over the years has been just, there should be people in jail over this, to be honest, because it is fraud. Anyway, what else we can offer? Designated underwriters from start to finish. So if you phone one of my team today and say, right, I'll use a second charge as an example, and you speak to a member of the second charge team, they will deal with that case from start to finish. My staff are experienced enough not just to do the initial, obviously speak to you initially, but actually underwrite the case, process the case, complete the case from start to finish. They don't need different departments because we're dealing with loads of like 18-year-olds who've only been in the market for 5 minutes and rely on the technology that they're using to try and get them through the day. My staff can deal with a whole lot. The only thing they don't deal with is right at the end, is when we complete the deal, it comes over to me and I pay you on the day of completion. No excuses. Unless the whole banking system goes down, we will pay you on the day of completion. Of course, we need your bank details. I do say to people sometimes we can't pay you unless we have your bank details. But it's something we do. In recent years, I'm trying to think, there is now three examples now. Renewed my wedding vows in 2018 in Spain, paid 3 brokers on the day I renewed my wedding vows, including one after I said I do again. 2019, my daughter got married, paid 2 brokers on the day that she got married, including one between her saying I do and my speech. And in 2021, I was in hospital last August having a shoulder operation. And on the day of the operation, I came around about 8 o'clock and I had a broker to pay. So thankfully, I was able to do it right because I was told not to enter into any sort of contracts or anything whilst I was under the influence. But I still managed to pay that broker on the day of completion. So unless I'm unconscious, unable to do so, or the banking system's down, you will get paid when it completes. It doesn't matter when we get paid. We haven't got a cash flow problem. I'm not expecting to pass one on to you. No commission clawbacks, unless it's fraud or unless the customer then decides to, for example, they got a 14-day period after completion, they decide to actually return the funds, which happens very, very rarely. A little bit about something else we can offer, because I mentioned this earlier on, because on second charge lenders are lazy. In essence, so that what they allow us to do is they actually give us access to Equifax and Experian. So that means that we can credit search clients with their permission right at the outset. So we've all had situations in the past where you said to a client, "Have you got any issues with your credit in the past?" Well, no, nothing at all. And then eventually, when you get it to lender and they get round to doing the search, what happens? Search is done, and there's something that the client either didn't know about or thought they could hide. Worst one I ever saw was a CCJ for 12.5 million quid that the client said he didn't have. Well, he did. And it was 3 months previously. So it does happen. So we search right from the outset. So we're going down the right road right from the outset. Absolutely vital. We do not want to be spending loads and loads of time on a case that's going nowhere. So we make sure we go down that right road by getting the search done with the client's permission as early as possible. And it's all at our cost. Okay, we also often, I've mentioned actually this in a couple of the, when the lenders were speaking, we've written our own software in-house that quite simply, because there isn't anything out there, and forget the sourcing systems when it comes to second charges, because they're normally only offering the products of one particular broker who seems to have cornered the market. We've written our own. And by crisis, it worked fantastically well. So if you give us a call and say, right, I've got this potential second charge, I want to see if it's actually better than offering a first charge remortgage. Within about a minute, we can say to you, okay, well, here's basically what's available. We can send you something on email. You'll have a PDF, something for your file. So if you decide to go down the remortgage route and you are independent, you should be considering second charges, you covered yourself off. Very, very simple. We've done the same with commercial. We've done now the same with bridging. So it just means my staff love it because all of their research goes pretty much out the window. All they need to know the criteria. They haven't got to sit there working out whether a deal fits on the rental income, for example, using a calculator. It's all done for them. Mentioned data security. No one's getting to our system. So my IT team tell me, and believe me, people have tried. Especially over weekends. Normally we are hit with numerous attacks over weekends, normally in the middle of the night from the Far East, and no one's ever managed to get in. If they did manage to get into our system, there's no data for them to find anyway. Full trainings offered face-to-face or virtual. If you're in Newcastle, it will have to be virtual because I'm not going to be travelling up to Newcastle to do a day's training. It's too far. But it's totally free of charge. You just tell us what you need and we're more than happy to do it. Second charge panel, we've had to take out Masthaven from this, unfortunately, due to their announcement beginning of the week, which is a shame. But we didn't give them a lot of business anyway because their products really were just basically about 5 years out of date. But this is pretty much everyone. You see that Pepper Money is now the new name for Optimum Credit, and there's a new one in there. You might see Scroll Finance. We're about to launch the market, and we are on their initial launch. So it's everybody, quite simply. We deal with every single lender in the marketplace. So if you've got a second charge, there is not any company out there that's got staff that are more experienced than mine. Our regulated first charge panel, where you give the advice, is this. We only accept business from our partners if on a regulated first charge basis, the prime stuff, if they can't do it themselves. Because otherwise what we find is, and we normally find it after one of our shows, what will happen is that we'll get cases come over which an introducer just can't be bothered with, but maybe up for 30 grand, for example, or there'll be massive problems. So if it's normal mainstream mortgage and you can offer the advice, then that's not really one for us. But any of those, more than happy to be involved. You can give the advice. We'll package it on your behalf. You'll see there's some lenders that you probably even heard of. Did you know that Central and Norton, for example, offered regulated first charges? And it's stuff that probably you could be turning away at this moment in time. If we're giving advice on our specialist buy-to-let panel, excuse me, we got plenty more than this, as you can imagine, but this is pretty much the ones that we use for the business that comes from our business partners. And it's, again, pretty much everybody you'd expect to see. If it's where you want to give the advice, we now have packager status with all of these particular lenders. So family, fleet. I'll pick out the ones where it's actually a true packager status. So family, fleet, Landbay, Lendinvest, Precise, Together, West One. All of those give us a call, because we don't charge any fees, any packager fees with those particular lenders. Whereas every single other company, as you see on one of the slides coming up, every company that we compete with does. So if you are on Mortgage Brain, 27 Tech, or I still call them Trigold, just look out for 0% fee specialist or specialist ... with those lenders that I mentioned there. And we do not charge packager fees, which obviously is great for you. And you get what you don't if you went direct. And there's a comparison. So if there's a comparison, you see you've got 3MC, Dynamo, Impact, etc., etc. Anything up to, on some of those, I think 299 quid is the highest there. We don't charge upfront or on completion. Bridging panel, we've got loads if we wanted them, but I tend to, we're very strict on who comes on our panel, so we just make sure that it's not anyone that's going to basically cause the clients major problems in the future. Again, that's if we, well, that's it, advised and non-advised basis, but we can actually give you the access to the market that you probably sometimes struggle with, because how could you maintain that number of lenders and know all their criteria? Well, we've got a system that does it all for us. A commercial panel, commercial was probably our busiest side of the business last year, because 2020 was a complete write-off of the commercial market, as you can imagine. So it's pretty much whole of market. There's some private banks that we use as well, but I tend to keep those fairly private for good reason, that do certain things from time to time. But we do a lot of business with Alico, we do a lot of business with Hampshire Trust, InterBay, Shawbrook, Together, Yorkshire Building Society, who are about as difficult to get on their panel as actually applying for FCA registration or authorization. It was as difficult as I've ever seen. And they invited us onto the panel as well. So it's pretty much whole of market. And again, we have a sourcing system that does all the work for us. If you want to advise on second charges, now there are brokers out there who are off list, but they'll charge packager fees. Quite simply, I won't go through the whole thing, but quite simply, we've got access to every lender in the marketplace. We've got a sourcing system that does all the work for you, rather than sourcing systems that don't work, which are available from the three main ones. Helps with your file compliance, and we don't charge any packager fees. So if you wanted, we've got one broker who uses this, and on every single deal, he charges the maximum. And if he can charge 5 grand, he'll charge 5 grand. That's up to him. Others charge 395 quid and are quite happy with that, because they're sending some protection products alongside it. You decide how much you want to charge as a fee. We have no input onto that whatsoever. As long as you're allowed to charge it, you can charge it. Not available for first charge mortgages. Like I said, we always get loads and loads of first charge inquiries afterwards, which really are on a package basis that we don't really want to get involved in. I'd always warn you to be aware of the bandits. There's still, unfortunately, some companies out there who will not only rip your client off, but rip you off big time. This was the best example I can ever give. This was when we were doing the physical shows, and this is one we did down in Surrey. A guy brought a case with him that one of his clients that he'd referred to a master broker for a 1.4 million buy-to-let portfolio application. It could only go to InterBay in this case. I can't remember the reason why, because it was obviously close to, well, probably almost 4 years ago. Quite simply, delegate was promised 0.5% or 7 grand from the deal as no commission. InterBay did not pay commission. Now, InterBay pay a minimum, and always have done, of 1.5%. They're also charging the client what originally was a 30 grand fee, but they dropped down to 24,500 because that was the maximum they could screw out the client. So what did we do? I know they were going to earn into 45.5 grand paying the introducer 7. That's wrong. That's really wrong. So Deal came to us. We did it. We didn't charge a fee at all because we own 1.5%. We split it down the middle with the introducer. We both went over 10 grand. Everyone was happy. Client was delighted. So great. The broker on this hit the roof when he found out, as you can imagine, because he lost 45.5 or 38.5 grand. Well, I'm glad he did. I'm going to do a couple of case studies. I won't. How long we got? We've got not long, and I've got a few more slides to get through. So, case study for a deal we did with Octane. This was last year. The rental coverage was 101%. Now, Octane have got a product that, as long as the coverage is 100%, it was still slightly outside criteria, but I know the directors at Octane very, very well, known them for many years. So we eventually arranged a 3.25 million case with Octane that completed, allowed the client to buy a property that was actually above one that he already, a flat that was above one he already owned, so he could then purchase the freehold as well. Introduced around 32.5 grand on the day of completion. Sorry, that's not quite true. You earn 20 grand a day of completion, 12.5 the next day, because I have to cap what I can pay out as 20 grand for security purposes. But you earned it, most of it, on the day of completion. So there's one. This was an expat we did with Hampshire Trust, living in South America, only had one property in the UK. They lived in South America for 10 years. I think it was Chile or Peru or one of those. Needed, basically, he needed funds for his retirement, quite simply. And normally Hampshire Trust wouldn't do this type of deal, but we was able to present it in such a way because we're Hampshire Trust's biggest introducer. They gave him a 2-year fixed rate. We acted as a packager, had no client contact at all, introducer, partner, earned almost 4,400 on the day of completion. Number 3, we did one. This is a bridging loan we did through Together. Quite difficult because of the type of property it was. It meant that it would have to have a valuation. And the staff at Together said it had to have a valuation. So I phoned somebody that I know very, very well at Together, who's a director I might have already mentioned, and said to him, we've got this case. I really want to get away with not doing the valuation. It's in London. This case is 22% LTV. He's got to complete it before the 30th. He said, fine. We'd have a look, just have a look on the internet, see what price the properties are going for. And half hour later, he said, yeah, it's already approved. And we got it through with 8 days to spare. Introduced around 3 grand on the day of completion. And we gave the advice on that one. The client was absolutely over the moon. The testimonial we got was fantastic. Almost last case study. Mentioned Roma earlier on. This was a 20, I think actually I've done it wrong. It was a 21-bed property, but only had permission as a 10-bed HMO. One of the difficulties was that it was found during the survey that the neighbour had been nicking the electric from the property for years. So that caused a slight problem, as you can imagine. We managed to get a 10-month bridge through because he needed to do some work to the property for 2.15 million. And we paid our introducer partner £21,050 on the day of completion, which was 1%, because we have package status with Roma, as we do with almost all of our bridging partners. So we will pay you what you would earn if you went to them direct. But of course, you've got the benefit of our experience and contacts in addition to it. Okay, and it's not what you know, it's who you know. This is probably the best example I've come across in all the years I've been doing this. So we had a husband and wife business running 2 very profitable children's nurseries. Mr. defrauded HMRC of 850 grand over a large number of years. Basically, he hadn't paid any tax, national insurance on their staff for years and years and years. He was caught out by a member of staff actually asking for a pay slip because she had to contact HMRC, and they've gone, we didn't even know you were working there. Sentenced to 5 years in prison. They divorced, but the police managed to get a Proceeds of Crime Act charge against every single property that he was on title of. Barclays called in both their commercial mortgages, and this was a very profitable children's nursery. I mean, it had 300 grand sitting on its current account. Northern Rock mortgage, a residential mortgage, are going to overturn, and she's about to lose everything. Declined by everybody, multiple lenders and multiple brokers, because of reputational risk, that dreaded term that we all have, that we hear from time to time. So this is what we did. Came to me to sign off as a decline. Well, actually, no, went to Together first of all. My staff put it together. Compliance department said, no, won't touch that. Case handed to me as a decline. I'd sign off all declines just to see if there's anything we can do. 10-minute conversation with a certain director at Together. Gave him the details of the case of Waltz and all. It was low LTV, fantastic business, very profitable. And his words were, why can't we do that? Well, your compliance department said you don't want to do it. Give me 10 minutes. 10 minutes later, it's different when an underwriter goes to a compliance department and they say, please, Mr. Compliance Director, I want to do this deal. And he goes, no, go away. But when the number 2 in a firm goes to the compliance team and says, I want to do this deal, and they go, okay, Mr. Number 2 in the company, we'll do it, no problem whatsoever. Came back a few minutes later, said, yeah, we'll do that. Introducer earned Went through, did the whole lot, paid off the proceeds of Crime Act, introduced rent just under 12 grand on the day of completion. And I think there's one, I only did this last night. This is what he actually sent us. I've had to blank out because he's a bit shy. I had to blank out basically. But I've underlined the main bit. The service you and your team provided and continue to provide is second to none and well beaten. And that's someone who's been in the market for a long, long, long time and uses us extensively to this day. Because that was the first case he did with us. And he tried everywhere on that case. So cases you can't place. If there's anything you can't place, you can use the message button at the bottom if you wish to. And details, we can call you back, just details of any inquiry, complete a decision in principle form. We're going to be sending you by email today. There's one for every product. Go to our website where you can submit cases online or call the number there. We're ready to take a call. This is our contacts. I just put these up very briefly. So our two main contacts on the regulated side who cover anything that's regulated are Kate and Kirsty, both massive amount of experience in the marketplace. Give them a call and that's their email details there. If there's anything that's unregulated, these are the three heads of department. Give them a call. Sakina is our 6-language expert. I can barely speak one, as you probably already realised. But give them a call with anything you've got, and they will be able to run you through the process and let you know pretty much straight away if the deal is doable. We've also now brought in a mention about invoice and asset supplier corporate finance, brought in John DeCuna last year, who's joined us basically to offer those products. And he's got years and years and years experience in that. He's also a qualified accountant as well. So he knows how to read a set of accounts, which most lenders don't. So you can give him a call, anything you've got. You would have been sent a request on, if you're on LinkedIn and we've been able to find you, you would have been sent a request from me. So please accept and we can keep you updated with what's going on in the marketplace. If that's not already been done, that'll be done this afternoon. If you'd like what you've seen today, you will also be sent today a broker pack with one of these, which is basically an agency application form. Don't need that back straight away for you to give us business, but I do need it before I can pay your commission. So that's the only other time that I can't pay somebody on the day of completion is they haven't returned that to me. So get that back to us and we can pay you on the day of completion. Next show is on the 3rd of March. It's always the first Thursday in every month, except for June this year because they decided to put that as a bank holiday. So it's the second Thursday in June. We've got Alika talking about their very new and very exclusive product that they're introducing, which are going to give full details on. Lenco, which is probably the best lender you've never heard of, who we do extensive amounts of business with because they'll do stuff on the buy-to-let side that no one else will do. My mate Jim from Tuscan Capital, who will be talking about everything bridging. And West One will be talking about their second charge product, which is probably one of the top 3 in the marketplace at the moment, and some really great products. And there's the details of the other ones we're going to offer. Just go on the website. This is all on the website, as you can see. So it's always the very first. We might increase that to 2 a month if we possibly can, if the interest is there. But once a month is certainly enough at the moment. Okay, I'm just looking at the time. We're fine. So feedback and CPD. When you leave today's session, there is click event board in the top right corner. Don't click it yet because I'm not finished, but click event board and then click the red exit event box. And that will automatically send you the feedback form and then automatically send you the CPD certificate. If you just close down the browser, it won't recognize what you've done and you won't get those. So the CPD certificate will come out to you this afternoon. You don't need to enter your name in the box anymore. Don't worry about that. It's not a problem because we've now overcome the problems we had last year. Feedback, help us out. If you'd like what you've seen today, just go onto Google and Google Review Specialist Hub or Trustpilot Specialist Hub. Leave us a review, hopefully positive. I hope it's going to be positive because we're trying to build our obviously online presence as much as possible. Don't go to specialists with an S hub because that's a completely different firm who do something completely outside of our industry. So you might be actually putting up a 5-star review of somebody that I don't even think they're in business anymore, actually. But if you can do that, that really would help us out. Okay, thank you for attending. We're 1 minute over time, so thank you for attending. Enjoy the rest of your day. Until next month, stay safe and prosperous. Thank you very much. See you next month.